governors from the Governing Council, from the ECB, are also acting in our domestic role as a governors of the central bank. And many of us are not responsible just for monetary policy, but for some other policies as well. And in my case, in the case of Bank of Slovenia, we actually already have 4 different mandates. This is monetary policy, the first one, probably the most important one. Then equally important is banking supervision. Then we are responsible for macroprudential policy. And finally, we are national authority for a resolution. So we already have 4 different mandates, which is actually a lot. And adding to that additional tasks, additional mandates, I would be very careful to do so. Many reasons for caution have already been mentioned during the first panel, and I completely agree that as a member of the Governing Council, we do have a clear mandate which arises from very specific situation which we had 30, 40 years ago, and that is price stability. It is true that in addition to that, we are also responsible for supporting general policies of EU, but my view here is that we must take this task more generally and not too specific.
Can I just follow up? What do you mean to very generally and not specifically? What exactly you have in mind?
For example, when we are comparing our primary mandate with other tasks which have been imposed on us for the monetary policy, we do really have a very clear mandate. It is a price stability. Mm-hmm. In addition to that, we just renewed our strategy, which defines into more detail what the price stability means. And at the moment, this is inflation around, HICP inflation around 2%. Mm-hmm. In order to achieve this goal, we do have a strategy, we do have well-defined and quite many instruments, conventional and now also some unconventional instruments, and also we have many years of experiences. Now comparing, for example, what we are doing in terms of green agenda, so to speak, the situation here is very different. First of all, we do not have such a clear target what we are actually hitting. Then, of course, the instruments are primarily not on us central bankers, but on other governmental institutions, Ministry of Finance, government as a whole. And those instruments are also not so well defined and, what is even more important, not so well tested as our instruments are. So when we are speaking about these other mandates, this is a completely different world for us central bankers at the moment, and that's why I would be very cautious in pursuing them. Of course, we can do it in a sense of supporting other institutions. We can do it, we can lead here by example, like greening of our portfolios, but regarding interaction with the financial sector, with the markets, it's a completely different story.
Thank you so much, and thank you for that very clear clarification. Governor Saiko, may I call on you about this proliferation of mandates, the challenge it poses for you, and how you are tackling it in Albania?
Thank you very much, Piroshka. First of all, I as well would like to thank you, the Central Bank of North Macedonia, and especially the Governor Anita, for inviting us. It's always a pleasure to be here. The topic is always interesting. We've discussed, but there are in time always developments that it's worthwhile to rediscuss and emphasize what is the role of the central bank and what are the implications. Of course, we all know that the main role of the central bank is the price stability, and we all work towards the price stability every day. Monetary policy is very important, and especially on countries like us in Albania, but many other countries, not everybody in the Western Balkans that have a free floating forex regime, this is really very sensitive. So the implications between the interest rate towards the transmission of the monetary policy on one side, combined on the other side with the exchange rate implication on the different groups of interests and population, are becoming a very complicated exercise for the central banks because there is a high level of sensitivity, impact and influence on the population and on the business agents. For example, we are now going towards appreciation of the local currency, which is good for the inflation, and it goes towards the mission of the central bank, which is price stability. But on the other side, influence negatively to the exporters and helps the importers. And people who has incomes in local currency benefits, and people who has incomes in euro loses. But since we have a lot of remittances in Albania, there are many people that have incomes in euro. So appreciation at that level shows strengthening of economic activity, shows strengthening of the purchasing power of our currency, and goes in line with our main price stability objective, which is keeping inflation under control. But on the other side, some people are losing. So this is very complex. In overall, we as a central bank sees that as a good development, but as long as there are groups of interest that are suffering, on the contrary, still we have to elaborate and see carefully. Not going more in details, I mean, the first mandate of the central bank, price stability through monetary policy transmission, is very important, especially in the economies that have high level of euroization, like Albania. This becomes more difficult because of the limitation of euro. But in parallel, we cannot neglect the financial stability. And as my colleague Boris said before, central banks are facing more risks sometimes from banking supervision and financial stability than from price stability. Price stability, of course, confront us with the market and issues, but on the other side, financial stability is very delicate. And sometimes in financial stability, even with a little mistake, as it mentioned, maybe not a mistake, but a little development, negative development in the market, it could jeopardize or compromise the whole good work that you have done in other side. But financial stability as well is linked with many other developments. It's linked with digitalization, as you mentioned, it's linked with financial inclusion, it's linked with many other aspects that central banks are working, with climate change as well. So in this context, for example, we in our country have done guidelines and policies. We have done a national strategy for financial inclusion and financial education. We have done a new guideline for climate change for the banks in order to address certain topics. We have been working hardly with the banking association and banking sector for digitalization, and as a matter of fact, banks in our country, compared to other industries and the related parties, are much more modern in terms of digitalization and offering better products. Still, there is a lot of work to be done. However, I mean, modernization of payment systems remains for us in a central bank as a main objective. Modernization of payment systems in compliance with EU payment systems like SEPA, inclusion with many other countries in the region, and then after implementing TIPS system, a clone of Banca d'Italia or something, to reduce cost for the customers, for clients, it's a very good. But all these objectives sometimes becomes very complex. And by communicating these objectives, elaborating these objectives, the expectation and perception on the public and politics and parliament and groups of interest on the central bank are higher. And the bigger issue in our countries, I believe I share the same opinion, is understanding the function and the role of the central bank, financial education in all levels. And sometimes when you are not understood correctly what is the role, for example, in climate change, it's not the central bank who is going to fix the climate change. We do our part for risks to the banking sector, but it's government who is primarily going to take the lead and fixing of the laws and everything, and many other things. And when talking about the central banking role in this context, sometimes we raise expectations that central bank may resolve everything, anything in this aspect, and the demands on the central banking role are high from groups of interest, from politics, parliaments, and media, and then we go in the contrary to explain our limitation, and it should be very careful. Definitely, we will address the central banking on this function because are related with our main functions, but should be very careful in communication and should be very careful even in developing some, because entering in some projects, CBDC, for example, is very complex. It's very good because basically we are going towards the modernized and digitalized transactional banking life, and crypto and all other currencies in parallel urge the need to address through CBDC, but we have also to see the complexity and risk to the financial stability. But when we announce that we have entered, then there is a demand that where you are, what are you doing? So it should be very careful, it's very sensitive. So as in conclusion, I could say that, of course, the main mandate of the central bank is price stability with its implication. Financial stability definitely is important because sometimes it brings more risk, but all other tools and all other projects that central banks are involved are important. It should be involved, and we are all working, I believe, but very carefully, not to overburden the work of the central bank, not to lose attention from the main objective, and not to take over more responsibility that we should take, because in a certain point we might get overburdened, messy, and instead of fixing things, might lose direction. Thank you very much.
Thank you so much. Let me follow up on the two governors' description of what is really core for central banks and what are the core tasks, and then what are the additional demands that can be considered in a different light. And what I take away is that, in addition to price stability, which is clearly a number one mandate, it is just as important to address financial stability concerns. After the global financial crisis, after all, we knew that partly the problem was too much fixation on a period of super low inflation and less attention to financial sector problems and risks that had been accumulating quietly behind the scenes, so to speak. So financial stability is almost at the same level of concern than price stability. And if you ask actually central bankers around the world what keeps them up at night, what is their main concern, they will not say inflation, honestly, unless it's hyperinflation of some outlier countries like, not to be mentioned here. But it's really financial stability, banking sector crisis. That is the key. So these core functions seem to be, as you say, governors, are critical, and everything else should be seen perhaps through the prism of these two mandates that are core. And let me ask maybe Mr. Kampa, from where you sit, head of the EBA, obviously with a little bit of bias toward regulation and financial stability. How you see this challenge for central banks?
Yeah, thank you. As you say, I may have a little bit of a bias, but I very much like the introduction that you put, that I think financial stability, as I also mentioned in my initial remarks, it's a precondition for economic growth and for many other areas in our society. So I think that it should be at the core of the tasks of any central bank, be it through its macroprudential mandate, be it through the delivery of proper monetary policy across the economy. On that perspective, if I may, some of those quote-unquote mandates that you were mentioning, I would not call them mandates, but I would say areas in which we need to look at carefully when you're in the central bank. And for me, obviously, right now, geopolitical tensions. It's an obvious area in which may raise concerns about financial stability. Nobody questions that the central bank should have a mandate on geopolitical issues, but they should assess them. To me, climate is very, very similar. Climate, the way we look at it at the EBA, is a risk that's coming to the financial sector. It's a risk that comes through, physical risk, through transition risk of society, through policy risk, climate policy risk in determination that may be taken or not by the actors that need to take that policy, and we need to filter that into how that filters into risk to the financial sector. For instance, in the European Union right now, we're doing with the other sectoral regulators, as well as with the European Central Bank and the European Systemic Risk Board, an analysis of what's the Fit for 55 strategy. This is a strategy of the European Union, a climate strategy for transition to reach 55% by 2030, and we're just testing the robustness of the financial sector to deal with that transition, whether it's orderly, whether it's not orderly, in a scenario of economic decline or economic relatively good performance. And I think that's a very relevant task for us as sectoral regulator and in charge of banking stability, but I think for the central bank more broadly. That's how we look at many of these mandates. Technology, by the way, is very similar, I would say.
Thank you very much. Let me turn now to the representatives of two very prominent international financial institutions. Jean, sitting next to me, Jean Pem from the World Bank. Jean, how do you see these challenges, particularly for emerging markets, central banks, developing countries, and with a little more focus perhaps on the digital, also on the issues of digital challenges in the new world of digitalization and what it means for central banks?
Thank you very much. Good afternoon, Madam Governor. Thank you very much for the invitation, and thank you very much, Mark, for having us here. So I'm going to focus on financial sector issue and emerging market, and maybe quickly on three topics: financial stability, coming back on climate finance, and then digitalization. So I think on financial stability, to add to what has been said on the core role of most central banks. I mean, some countries have independent supervisor, but let's focus where this is a mandate with the central bank. If you look at the FSAP, and we have quite a bit of experience with the IMF, we still see some fundamental issue in terms of operational independence of the supervision, legal protection for the supervisor, clarity in the institutional arrangement, and all of this contributes to protecting also the role of the central banks as supervisor. So it's not in every country in the world, but there are still some issues there that deserve a lot of attention, and that also very directly relevant to the quality of supervision, which is really fundamental to that. And if you don't have all these mechanism and operational independence, then it affects quality of supervision and potentially the independence and the ability to do their job for the central banks. Now, in crisis management, what we see is that there are still a lot of emerging markets that do not have the tools in place. So they do not yet have the tools in terms of institutional arrangement, in terms of safety nets, crisis resolution, crisis management. And that means that when a crisis hits, then the issue of who does what and the roles, in particular between the Ministry of Finance and the central banks, become very complicated. So I think one of the lessons learned there is the more you act ex ante and put in place the appropriate legal institutional framework, the more also you protect the independence of the central bank, in particular situation that was mentioned a little bit earlier when you have sovereign nexus issue, because then the different roles and different objectives may become very complicated, and in particular when you have state-owned banks that are exposed, because then you add an additional layer. So it's not in all emerging markets, but in some of them that's something important, and I think one of the lessons learned also of the last crisis is that it's better to have that before than having to fix the situation when you're in crisis on top of having to put in place the institutional legal arrangement. Second message on climate finance. I think the risk aspect is pretty well recognized and I think considered like in the traditional mandate. I think one of the elements that we see in emerging market is also the difference between mitigation and adaptation. So there is clearly an element of thinking adaptation, and the toolkit at the moment is very much a mitigation-driven one. So a lot of effort on adaptation, including putting in place and helping the supervisor to think about stress testing, climate risk. So again, these are things that the international organizations are doing, but where there is a lot of learning, but where it cannot be done only by the central bank. So that's where the coordination with other entities, so they were mentioned earlier today on taxonomies, that's one of these examples. Where we see a lot of pressure on the central banks is climate finance bringing private capital, because then there is an expectation I think because you look at risk, then people think you're going to do something. And some central bank push to use tools that are either not totally, where the jury is still out, including directed lending and these kind of things. So we see an evolution where there is a lot of innovation, but we don't know yet what's completely the impact, and continue to watch that space, but also avoid that because action is not taken in other places of government, then it goes to the central bank is really important. And I would add one last message on this, which is banking versus capital market. In most emerging markets, it's very bank-centric system, so there is a temptation to ask banks to do a lot. So we actually have a recent publication where we show that 60% of the banks in emerging markets have less than 5% of their portfolio on climate finance. So more needs to be done, but also, and that's also another element of internal coordination, domestic coordination between the banking and the non-banking sector. And last element, I wanted to come back on the issue of digital and payment. That's a core function of most central banks, and it was considered like plumbing. I think with digitalization, that has completely changed. This is a main driver of digitalization of the economy, digital financial services, so obviously domestic payments, and supporting in terms of digitalization of the economy, but also cross-border, and making sure that cross-border payment work much better. So there's a big agenda there, one that in the Balkans have been very active, and we are very happy to work with the countries, but where, again, the central banks play an important role, and where the networks of the central bank plays a very important role. So is that a risk on the independence and the mandate? I don't know, but this is a core contribution, in particular to the digitalization of the economies.
Excellent, thank you very much. Francis, turning to you, how do you see from your perspective this increasing mandates, tasks and demands on central banks? Where do they have succeeded, and where are the real challenges, the problem issues that you identify from your perspective?
Thank you, Piroshka, and thank you, Governor. Thank you, Mark, for the conference. It's very topical, and I'm very pleased to be here. Look, I mean, the way I see it is very simple, if you would. Central banking is becoming increasingly complex, because the world around central banks is also increasingly complex. And this question of evolving mandates, for me, is a question of evolving risks. If you are a central bank and you focus on the financial stability of your country, and you have to focus on the short term and the long term, you have to ask yourself the question, okay, how does financial stability work when half of my country has become inhabitable due to climate change, drought? How does my financial system work when we've let inclusion run loose? Inclusion is probably the largest failure of Western European and Western politicians in the past few decades. And you look at the results now in the political trends that are shaping up. So how does in the extreme, if my country goes into civil unrest, how does my financial stability look like, right? So, and same for technology. How does my financial stability look like? How do I resolve a bank over a weekend when in parallel customers are busy creating a bank run on WhatsApp loops and withdrawing their money online? And banks are actually not closed on Friday at 4 p.m., right? And so these are trends that exist, that have appeared, and that central banks need to reflect. And so for me, what drives all of these new mandates is two things, is the risk, and is also the societal demands. And we had Gilles on the previous panel talking to us about the institutional independence and the societal independence. There's a lot of demands on banks from the population, in part due to lack of proper financial education and overestimation by the population of the power of bankers, but also in part because central banks are too good. Because when you do something, it works. Banks actually implement what you ask them to implement. Ask any other regulator, ask a finance minister, if people start implementing what the minister wants in a way that banks do it when you, as central banks, make these decisions. And you will see there's a big difference. And so it's a convenient way to do things, to ask the central bank, to ask the banking sector to achieve results. And of course it does achieve results. The consequence of it is also that it drives money away from the banks, right? And you see money shifting from regulated banks into non-regulated banks. Now, in this region where banks intermediate the vast majority of the economy, we don't see it fully yet, but it's clearly a trend in the larger markets of the US and Western Europe. And so, for me, the more central banks are successful at working on their mandates, understanding risks, working on climate, working on inclusion, and so on, the more pressing becomes the issue, hint to maybe Jose Manuel, of how we regulate the non-banking sector. Because if we want to take CO2 out of the atmosphere, passing the financing from banks to investment funds doesn't work. The CO2 continues to go into the atmosphere. It moves away from the balance sheet of the banks, that's for sure. So we measure the banking sectors and we're good, right? So how then, what works in my view? First, again, central banks are very successful, and I know I have an audience of central bankers, so it's cheap to give them praise, but I do believe and I observe that central banks are actually doing a very good job once they decide to do something. The second thing that I think central banks provide, which is fantastically useful, is that they provide a frame of reference so that every bank knows what is green, what is not green, what is inclusion, what is not inclusion. You'd be surprised if you realize probably that a lot of banks that I work with, we at EBRD work with 350 or so partner financial institutions across 36 countries, do not even know which of their clients is a man and which of their clients is a woman. Obviously, the branch manager receiving the client will, by and large, realize. But in the statistics, in the systems, there's no marker that this client is a woman. So how do you design an inclusion program for female entrepreneurs if you don't know who is a woman, right? And so once banks decide who is a woman, who is a man, and they have banks put it in their systems, then you can start having programs that are not necessarily the task of the central bank, that can be the goal of the Ministry of Finance, the pressure from population, and so on and so forth, but at least you can do it. And so having these sorts of frames of reference is extremely useful, and that's also where we as IFIs and informal international groups play a big role. And just to take the example of the NGFS, for example, I know Jean is on the governance of the group. A few years ago, 4 or 5 years ago, I would go see a governor and ask them to please consider to become a member of the NGFS. There were already 25 members and so on. These days, there's 140 members. So when I'm seeing a governor in a country whose central bank is not part of the NGFS, the conversation is more like, what are you guys thinking? And that is a very useful group because it provides an opportunity for central banks to exchange information, exchange practices, and so on. And one of the initiatives we have in that field is also in the field of inclusion. We are actually helping central banks to codify and to get the economy to measure gender differences. We have a We Finance Code initiative, which is supported by private donors, in which we help banking sectors measure gender gaps in a much better way than before. And so that's how typically, if you don't have a central bank taking on the task, the banking sector is going to listen politely. The moment the central bank decides to take on the task, the banking sector will start doing it. And so it's extremely powerful, and I've seen a lot of positive impacts from central banks on climate stress tests, on exchanging information, on gender data, and so on. So I'm more pleased than displeased with the way central banks integrate these new risks and work with their banking sectors.
Thank you very much, Francis. I'm sure the central bankers here in the room will be very pleased to hear your view that they are just too good. And this is one reason why there is so much demand on their services. Now, turning a little bit away from this proliferation of tasks and mandates that we so far have focused on, can I direct your attention to the toolkit, the new toolkit that you have now in central banking? And particularly, talking about quantitative easing, the famous QE, that is now being gradually reversed, more by the ECB than by the Fed, and some emerging markets which also had engaged in this. So quantitative easing and the currency swaps, which to my mind, as I said in my little intro, it's a part of the new additional toolkit at the international cross-border level of financial sector management, central bank management. And any other new instruments that you want to raise, whether it's direct finance for certain issues, climate or non-climate related, a lot of pressures on industrial policy finance, even in very advanced countries by central banks. So let's talk about the toolkit. What are the new elements and how you view the experience so far? Governor Vazle, can I ask you first?
It's one must not forget in this period of elevated inflation, still high inflation, that before the COVID and second crisis, Russia aggression on Ukraine, there was an extended period of very low or too low inflation prevailing here in Europe, but also in some other parts of the world. And in such a situation, the central banks hit so-called lower bound, and we were not able to lift, to increase inflation with existing tools. So new tools were devised, were implemented, and to name just a few, it was negative interest rates, it was QE, and it was forward guidance. Now, looking back with some, probably not enough distance, but with some distance, the experiences are very mixed. Mm-hmm. And regarding QE, it was basically used for two purposes. The first one was to address financial market instability or dysfunctioning of some particular segments of the market. And the second was, as I mentioned, deflation or permanent risk of low inflation. So to target the whole yield curve. I think, according to my understanding, that some of these instruments will stay with us. It's also true that they are incorporated in our strategy, how we conduct monetary policy, and some others will probably play less prominent role. And at the moment, we are still seeing the consequences. The process of QT is far from over, and I think yes that QE is something which will stay into our toolbox and will be used in the future as well.
Can I ask you specifically, in addition to QE, something that you mentioned, and I should have mentioned, forward guidance, and the experience with that. Given that there were periods when it served central banks reasonably well, particularly at the beginning, after the global financial crisis, but it at the same time seemed to have trapped central banks when data and inflation numbers, everything were changing rapidly, and they were stuck because of forward guidance commitments to certain policies that no longer seem to be really adequate. How do you see today the overall sort of lessons from forward guidance? To what extent central banks really can use it?
Some of the instruments I mentioned are very context specific. They can be very useful in a certain situation, but have quite the opposite effect in some other situation. And now, speaking about forward guidance, where we had this persistent trend of too low inflation for a very long period. Of course, it was very useful to give the markets a guidance, to give them additional assurance on what we are doing. But when the situation is more volatile, when we are at the turning points and when we are faced with a lot of uncertainty, then it's obvious that this instrument is not so useful anymore. And this is also one of the main reasons why we at the moment change our approach towards conducting monetary policy, and now our main guidance is to being data dependent and to decide on meeting by meeting approach. So basically at the moment we are in a very, very different situation. No longer term indication on what our interest rates will be. Quite the opposite. We are monitoring very carefully the incoming data and then adopt decisions on each meeting.
Thank you. Government Seiko, you are a little bit of a champion of communication among central bankers, particularly in this region. In addition to Governor Anita here, you've done a lot in kind of communicating both the financial stability, the inflation risk, but also financial inclusion issues. Can I ask you how you have looked at this forward guidance, to what extent you have been able to use it, or did you use it differently than some other central banks, advanced central banks earlier?
Yes, actually, we have been using the forward guidance from years as an instrument of transmission of monetary policy in some extent, because even communication it's an instrument of monetary policy. So forward guidance definitely orient the markets and give the right information, and is related, as I said, not only with transparency, but with orientation of the markets and individuals about the policy of the central bank in terms of monetary policy, of interest rates and other economic developments, how we see the market. Because usually central banks, after any meeting of supervisory council or even in other events, communicates the policy, but specifically after some, for example, we have 8 regular communications officially after 8 monetary policy meetings on a yearly basis. But even additionally, there is a lot of forward guidance. Forward guidance has an effect, but I believe the more educated the more educated the markets in terms of financial education, the better can function the forward guidance. The less educated, the forward guidance is still good, but as it was mentioned in the previous panel, the communication, it is very important, and the language of the central bank, we face challenges, it should be adapted. It's a challenge, it's a big challenge with the people, because, I mean, industry understands us somehow. Macroeconomics is complex, but however, industry, I mean banks and financial sector. Then business agents needs a different language. People needs a different language. So in order for a central bank to communicate with all groups of interests and population and people, it should be very smart in communication. And in addition to the forward guidance, it is important the communication, because we are in the world that everybody is communicating too much, is using the online media and portals and different ways and social media in communication. People are tired and need short and simple messages to understand or to be attracted. And central banks makes theory sometimes which is correct, but it's not attracted by the people, and nobody hears or understands you. But when there are related things in terms of interest rates of the loans or tariffs or costs or fees of transactions that they feel that they are high, they might blame you or complain on you. So communication, it should be definitely adapted, but this is a very difficult exercise. So in terms of, in addition to forward guidance, I think a very big challenging for central banks nowadays, it is to adapt communication professionally and smartly in order to be understood by the people.
Thank you. Jean, I would turn to you. You mentioned with regards to toolkit and what type of new toolkits and new procedures you can build around the new toolkit. So in your experience and judgment, what would be give us a few concrete examples on this ex ante arrangements that you have alluded to in your previous intervention. Ex-ante arrangements that would help countries to better manage crisis, but in general, better manage central banking. Give us a few examples, please.
Well, let me start with the stability. Some of them are very classical. The key attributes, they were mentioned earlier. You still have a lot of emerging markets that do not have all the toolkit in mind, that do not have the mechanism to resolve a failing bank, be it systemic or not systemic. All the elements on what's the role of the current shareholder and domestic, non-domestic. So a lot of that is about having the toolkit in place, the legal capacity to do that in a way that in those situations will help resolve. You also have the difference between liquidity provision and solvency resolution. Again, in a lot of countries, it's not clear. We would provide the liquidity support. So again, that raises question on who does that, who is going to pay at the end, etc. So these are the kind of examples that I have in mind. But since you're on toolkit, maybe two other things. So, and thanks, Francis, for having mentioned the NGFS and other bodies. So we see a lot of things happening on modelization of climate risk, be they physical risk or transition risk. This is something on which there is a lot of learning, leading also to better ability to do climate stress testing. So that's an example where the global community is discovering that to some extent, and where more work and more exchange of experience is important. That leads to the taxonomy. So just one number, 10% of emerging markets have taxonomy, 76% of advanced economy. So these are things that are being developed, and sorry to put it that way, the EU taxonomy is not going to be relevant in a lot of emerging markets. So there is also an element of collectively learning and sharing information. I'm going to give another example linked to financial inclusion. The main toolkit there are the new service providers. And that's the part where the banking sector supervisor and those managing a national payment system have a key role to play, which is bring new players for innovation, but also for more competition. And then we get on issue of interoperability and issue of innovation in the financial sector. So there are very specific instruments that may not be completely out of the box, but this is pushing the envelope and managing very carefully this balancing between stability and inclusion, and I think a lot of countries are doing that on a day-to-day basis, and we need to learn out of this.
Excellent. May I add one thing to the pre-arrangement, ex-ante arrangement idea that I think we all have to take to heart. One additional idea is that these arrangements would need to include exit policies from crisis management, exit policies from QE. When exactly, when central banks would want to exit, at what benchmarks? Because I think that may have added to the challenge and sometimes confusion in communications. Mr. Kampa, I'd like to follow up with you on one element that we haven't discussed and Francis has already raised, and that is that the banking sector, also as you said it in your keynote speech, is now well regulated and has proven to have been resilient in the context of the pandemic challenge. But there is one sector, the non-bank sector, the non-bank financial institutions, which are having a free lunch, so to speak. They are less regulated, they are taking up the competitive space, and they carry risks, as the IMF, the World Bank have highlighted many times. From your perspective, you're in charge of banks, and then, how do you see the regulation, the management of those risks that come from the non-banks?
Thank you for the question. As you said, I represent the European Banking Authority, so it's always a little bit awkward for me to talk about non-banks, but at the same time, it's nice to talk about something that is not on your profile. But no, more seriously, there are, from our perspective, so there basically, first part is I'm very happy to see that the Financial Stability Board, the G20, the ESRB, all the global institutions are really taking a serious look at this, and I think it's the right thing to do for two reasons. The first one is because we know very little about it, and the second one is because it's grown a lot and it's become big. So if it's big and we don't know about it, well, at least we should look into it. That doesn't necessarily mean there are risks there, because since we don't know, I don't want to say there are risks, but we should look at it. So that's really good news. From our perspective, or from the perspective of the banking sector, 2 points. The first one is obviously, it is true, as you indicate, that if you regulate one sector more aggressively, as part of the activities that it was doing before, it's not doing them anymore. Those are intended consequences, so that's good in principle, that it's moved outside the banks. It's probably also good if it's moved to other entities, other parts of the financial sector that are doing it in a quote-unquote better way or more risk-adjusted way. I think some of the, for instance, some of the movement away from OTC derivatives into organized exchanges, that's probably good, and that's something that is healthy. There are other areas, private credit, in which we have a bit more of a concern, but maybe, their liquidity mismatches between the lender and the borrower are less than the banking sector, so that may also be a good sign. I don't know, but we should look at it. That's one aspect. The second aspect is the fact that the banks continue to engage with those institutions, with the non-bank financial sector. And so what's happening in that engagement is something that for us is an area of focus and concern. Again, because in the past, in the global financial crisis, we also knew that there were things that the banks were doing with other parts of the financial sector that we thought they had left the banks. And when the crisis came, actually, it all came back to the banks. So that's one area of concern, making sure to what extent, that relationship is a relationship with risk is being transferred and is really being transferred, or it's just being sort of postponed until the crisis comes and then it comes back to the bank. So we're monitoring, what kind of activities they're doing, just in the balance sheet of, for instance, of the EU banks. The non-bank financial sector has about a 10% weight, both on the asset and on the liability side. So the banks lend to them, but they also borrow from them. They provide liquidity services. So that's a relationship. It has not grown a lot over the last 4 years, but it's an area of focus.
Excellent. Thank you so much. We have 5 more minutes only from this discussion. So I'd like to ask maybe every one of you of this particular challenge in the new digitalized world of central bank digital currencies. In your professional activities, one way or the other, you address this challenge. As central bank governors, whether to introduce it or not, what are the pros and cons, from the perspective of where Francis may sit, how does it really fit into the whole financial sector development from the viewpoint of the private sector, whether it's an additional competition or there is complementarity. So how do you see the challenge of the digital euro, as we understand will be most likely introduced, and the digital national currencies in your possible new toolkit? Can I start with the governors on the panel? Yes, Governor.
Yes, thank you. As you know, we at the ECB. Yes, as you know, we at the ECB started the process very early. We were among the first central banks who initiated the whole process, and we actually started with the investigation phase, which was basically the place for a decision to proceed or not. Then at the end of this phase, we decided that it's worth continuing the process. So we are at the moment in the second stage, second phase of preparation, when we are discussing already various details, how the system will work, how different participants will be able to communicate in this new domain. So for what we are actually waiting at the moment is not so much a technical solution, but legal basis for this, which will be on the new commission to be established. So in general we think that by providing the citizens the digital euro, we will actually go with the flow. We will introduce basically third way of payments, of money. And what is also very important for us and for me personally is not just the monetary aspect of the whole project, but also the payment side of the digital euro, because payment systems is the area we are still facing very serious challenges at the moment.
Thank you. Governor Saiko?
Well, CBDC for Slovenia, for example, is an EU member, and the European Central Bank will develop, and they, as a central bank, have to be in line and coordinate. But for countries that are not EU member, that have their own currency, local currency like us, we're still on the study phase. We have created a working group studying about CBDC development, but I am not sure. Well, first of all, this is a big development and brings a lot of challenges and a lot of risks in terms of financial stability again, but also for the inflation. So we have to see, definitely it's very good to have a digital currency, but it has to have the infrastructure as well, and it needs some steps, definitely. And on the other side, for a country like Albania specifically I speak, there is a high level of euroization, 50-50 of the current. This is another challenge that we are working, that 50% of the financial market loans and deposits are in euro, and also in the real economy, euro is very much used. So in case that ECB will develop CBDC, it will be an entering and using of CBDC in our financial sector, definitely, and in the people too. So in some extent, we are involved, we are integrated in Eurozone by the currency, as long as half of the currency being used, despite the fact that we are having a de-eurization program, despite the fact that we look and work hard to increase the usage of local currency because this is good for people and good for monetary policy transmission, still euro is there, and still CBDC, and as you raised the question, will enter in our market through ECB development. So basically, then we will see what we're going to do in the near future. I mean, because we as a country intend to be EU member. So this is a long story. We're not politicians, talks monetary policy. Politicians are this part. But however, as long as we intend and work hard to meet the criteria to be EU member and chapters and all this work, one day we'll be, we suppose, too. So at this day, we'll be in euro. In euro might be later, because like Croatia, it is now in euro, but EU member was earlier. So I don't know how this could be evolved with CBDC evolution. Is it worthy for central bank? Maybe the technology will be as fast as it will urge CBDC evolvement and evolution, even for countries like us, as North Macedonia, that have our own currency. Or not, or maybe if it takes time, it's not needed because euro, CBDC will cover the market, and why to develop CBDC? Well, we are studying, I cannot tell you more.
I think it's loud and clear, and in a very broader context, you know, Albania, North Macedonia are part of Europe. And whatever is the political process, that can be complex, multifaceted, but in the end, economically, you are so integrated already at so many levels, through the banking sector, the whole financial sector, through platforms, payment systems, and the region is very Euroized. So one way or the other, you are in Europe strongly already, and any future developments of digital currencies should be, as you've pressed, should be seen in that light. Mr. Kampa, your thought on the subject?
Very quickly, we're not obviously responsible for the central bank digital currency, but actually within the European Union, as part of what's called the MiCA regulation, we are responsible for the supervision of privately issued digital currencies and e-money tokens that may come forward as of June of this year. Our perception at this stage is that the appetite about these projects coming forward is limited. You know, there are a few that are going forward, but we don't expect that there's going to be a big flood of privately issued stable currencies coming in the short term. Maybe because obviously, if the digital euro goes forward, that's a clear alternative that may be in the market.
Francis, in your world, do you see already, are you dealing with central banks which are contemplating their own digital currency?
Not really, I must say. That's probably something we need to look at a little bit more closely. I mean, My impression from CBDCs is unfortunately also quite simple. I was recently in a roundtable where lots of luminary experts were discussing it. And the only thing they could agree on is we need to have it because the other guys are doing it too. There were some people said it's only for corporate payments, other people said it's only for retail. The use case is for small payments, it's for large payments, it's for killing Visa and MasterCard, it's for whatever. Again, the only thing that they could agree on is we need to have it because the other guys are doing it as well. So, one thing I'm sure is the private sector will adapt, and we will have, the ability to support the private sector in adapting.
Very clear. Jean, there is need for leadership in this space. What are you going to do about this in the World Bank?
So we are obviously looking at it, but part of a broader discussion on digital payment mechanisms. And that's the part where I come back to the question, what's your fundamental objective? And then what are the instruments and how they compare? And I would add one distinction, which is wholesale CBDC versus retail CBDC. And I think there is an increasing level of attention to wholesale CBDC as a way to facilitate settlement. I think in emerging markets, still cautious on retail, including because you need the fundamentals of strong payment system, but also because in some countries you may have a risk of disintermediation of the banking sector. But I think that's the part where, more than the instrument, stepping back a little bit and what do we really want to do? And I would say this is a topic where it's not just a central bank topic. So that's one of these examples where, of course, the central bank have a key role to play, but it's more a societal issue as was discussed earlier.
Excellent. So our time is up. We had a very wide-ranging, I think, discussion on the new mandates, the pressures on central banks, and the consensus that emerged here was that there are two core mandates: price stability, of course, but also financial stability, and everything else probably can be channeled through those mandates. And one more idea that I would highlight from this panel, in response to how Alfred has challenged us in terms of solutions for all the new challenges in central banking, is that in addition to risk management that also Francis highlighted here, there needs to be ex-ante arrangement, as Jean highlighted, as several of you echoed, to deal with crisis situations. Stress and crisis will happen. That's a fact of life. It's better to be prepared, to have good ex-ante arrangements, which hopefully have also exit policies from special arrangements in the future. Please join me to thank the panel for this discussion.
Dear guests, you are all welcome to join us for lunch, served in the lobby. Enjoy the meal. See you in the next session. And the panelists to take their seats.
Yeah, good afternoon. Good afternoon. I hope you had a good lunch. We are now back, and I would like to start off with maybe a first statement. You may find this panel, the way it looks, maybe a little bit different from the previous ones. But I wanted to caution any maybe premature conclusion. What we are discussing now is not a women's issue. It's actually a gender issue. Yeah? And in this sense, I think we are just very, very lucky that we have a couple of really great leaders in the room who actually will guide us through this very, very important discussion. Now, on this panel, we do have a couple of governors from the region present. And the other striking observation, at least for me, was when I looked through the backgrounds, I saw that 3 of them are actually in their roles less than a year. Yeah? So we have Irena Radovic, Governor of Central Bank of Montenegro. She is governor since December 23. We do have Jasmina Selimovic, who is governor Central Bank of Bosnia and Herzegovina since January 24. And we do have Anka Dragu, who joins us virtually since December 23. She is governor. Anita Angelovska-Bezhoska, our host, governor of the National Bank of Northern Macedonia, is already governor since 2018. And then, of course, we also have a video from the governor from Serbia, Jogovanka Tabakovic. He is in place for quite some time. Now, you know, when I had this call with Governor Anita from the National Bank of Northern Macedonia early in the year, I was actually very happy and very pleased to be invited to moderate the session, because in our work, which is the Alliance for Financial Inclusion, is a global network of 85 countries, central banks mostly working on financial inclusion issues. This whole gender dimension, of course, is a very important one. And it's not only important in terms of how do we actually include women into formal financial services in a safe, sound, and high-quality manner. It's also a question on female leadership, especially in financial regulatory institutions, but also in the financial sector as such. Now, that's the reason why I really thank the National Bank for inviting us to have this discussion today. And we have 1 hour for this, so we want to be short. So I don't think that I have to give you too much context setting. I was actually very grateful. The gentleman from the EBRD already provided a segue in his presentation today when he talked about the gender neutrality that we still see when financial providers are asked about their clientele. Very often they can't tell you the composition of the clientele in terms of gender. It's a very interesting observation. But there's an implication, of course, and there are policy recommendations following from that. Now, as you all know, financial inclusion has evolved quite rapidly over the past 15 years. We went from access to usage to quality. We do see financial inclusion as part of the core mandate of the central banks nowadays, which of course gives them a big role. And I think what is very clear nowadays is that financial inclusion is not really about bringing people into the formal financial sector. It is even more important to keep them there, to maintain high level of inclusion. Now, with this understanding, I think financial inclusion, I was very happy to hear today from the other Alfred in the room, who's another German also called Alfred Kammer from the IMF. I think he talked about financial inclusion in a way that it confirms our view that it has really moved into the mainstream of economic and financial policy thinking. And it also is very clear that high levels of inclusion is in the interest of everybody, not just of poor countries. We have seen this as a continued trend over the years. And ultimately, I think we're all aware that financial inclusion is also an important enabler to achieving the Sustainable Development Goals. And this brings us now to the very important topic of this panel discussion, women's financial inclusion, or as we call it, gender inclusive finance in the Southeast European region. We want to, of course, know a little bit more what is behind this. Why should gender inclusive finance be advanced? We believe it can contribute to economic growth and development. And there are numbers, for example, the McKinsey Global Institute has come out with a number telling us that the global GDP could grow by $12 trillion if gender gaps in economic participation could be reduced. I think that's a quite impressive number. And when you then look at the region, we find that according to UNDP research from 2023, that women in the Western Balkans are underrepresented among entrepreneurs and business owners, around 27.5%. But not only that, they also usually are engaged in activities in smaller, non-capital intensive sectors, which often do not generate higher and sustainable incomes. Now, although the gender gap in this region is relatively low, still around 3% on average, challenges seem to persist, especially with regards, you all know that financial literacy, supply of services, even social norms still do stand in the way. With this context, I think it's now for us to discuss, and I really break it down to very simple questions. The first question is, for these great panelists, how important is this topic for you? And the second question is simply, what can central banks do to support and enhance gender inclusive finance? These are the two questions we are looking at. And before I invite the governors here on the stage, we will get a video from the Bank of Serbia by Jogovanka Tabakovic to answer some of these questions before we then continue with our discussion here. Thank you so much.
Dear colleagues, a man can live without a woman, but without women, there is no future. This is a fact. But just I believe that it is wrong not to promote someone only because that person is a woman. I also believe it is equally wrong to give someone a chance only because that person is a woman. Dear Anita, dear governors and ministries, Mr. Henning, I'm truly sorry for not being able to be with you all in person. Yet, I wanted to support this event, even if it means virtually. Here are my observations. First and foremost, I strongly disagree with any kind of divides. I don't believe in quotas, as I know that all of us, my dear women colleagues, are heading our institutions because of our achievements, not because of our gender. I believe in the power of diversity. Second, I will give an overview of the situation and statistic in Serbia with the National Bank of Serbia as the first choice to start with. The number of women at the National Bank of Serbia has been on the rise since 2013. Today, women make up over 57% of the total number of employees and over 58% of the total number of managers of the National Bank of Serbia. There is equality in terms of the average level of job coefficients for both genders, and this applies to both employees and managing staff. In line with the law of gender equality, we introduce the risk management plan for violations of the gender equality principle. And not only do we have the regulatory framework in place, but we truly apply the equal opportunities and gender equality policies. At the state level, 10 years ago, within the law of the election of members of parliament, we introduced the minimum quota for female MPs. Today, women make up 37.6% of all MPs and are heading on 1/3 of all ministries. A special committee on human and minority rights and gender equality was established, as was the coordination body for gender equality. We have gender equality strategies and action plans until 2030, and a minister in charge of gender equality, prevention of violence against women, and economic and political empowerment of women. Also, the gender equality law defines the competence of the National Bank of Serbia regarding the supervision and insurance services where gender cannot be used as a factor in calculating premiums and fees. As you can see, in Serbia we have an excellent regulatory and institutional framework that empowers women. Therefore, I cannot advocate for gender-tailored financing in Serbia, as women have equal access to financing as men do. Together with the government, I am laying groundwork for a fair and predictable business environment that will support every project that has capacity to finance itself. But at the global level, we have quite a different situation across regions. If we look at the presence of the Alliance for Financial Inclusion, it is mostly focused on regions with a huge gender gap in many areas. Around 65% of Alliance activities are related to Africa, which comes as no surprise, having in mind that many women don't have a basic bank account. The region with the high presence of women working in informal sector is again Africa. In our region, this is not the case. Again, we are all aware that one of the factors behind less women financing is the lack of mortgages. In some countries, it is cultural tradition to have men as the sole owners of housing. It is a matter of social norms. Can we change the culture via policies? This is hard, but achievable, and it will take time. For financing, one needs a safe job and a good credit history, or if it is new businesses, one needs a good business plan. Yet, research suggests that factors such as culture, parents, and educational materials are shaping women's interest in their early age for the areas that are less profitable. We have to change this. We have to be loud enough, and we have to make it clear that there are no women and men jobs, and that we are just as capable of specializing in technology and engineering as men are. Dear colleagues, let me conclude, and let me to be quite open. Not everything is for policies. Instead of waiting for the regulator and government to solve gender and all other issues, it is far better to address the real causes of the problem. I believe that one must be aware of what the government can do, what the private sector can do, and what individuals can do. There are plenty of opportunities, but they need to be used. In Serbia, regulations are gender supportive. Financing is also gender supportive. There is plenty of opportunities for both women and men, but we have to recognize and use them. The system cannot do that on our behalf. Even better, we ourselves have to create opportunities. We can contribute by motivating and inspiring others with our own experience. We need good examples. We live in societies where people are more open to bad examples, and this is the mindset that we must change. For that, we do not need regulations. As for central banks, the best way to contribute is by delivering stability and predictability. Thank you.
Well, thank you for sharing this video with us. I believe we want to plunge directly into the two questions that I've put up, and I would like to start with our host, Governor Anita. So how relevant is this for you? If you could share what common challenges are impacting women's financial inclusion and are contributing to a gender gap in the region. What's your view on this? Thank you.
Okay, thank you, Alfred, for the question. And first of all, many thanks for my colleagues, speakers on this panel that are truly supporting this event. And I'm really delighted having such women here, which are really good examples of female leadership. Concerning the financial inclusion, let me speak with numbers. Looking at the final statistics as well as different surveys on this matter, I think one can conclude that globally, despite the progress in the recent years, financial inclusion gap still remains. And this is also a relevant question for the region as well, I would say for most of the countries in the region. Now let me illustrate with a couple of commonly used indicators about the gap of the financial inclusion. First, access to accounts, and second, access to credits, access to loans. Concerning access to accounts, I think it's clear that men prevail as owners of the account, as globally 80% of the men 15 plus have accounts in financial institutions, vis-a-vis 70% of women. And we know that having an account is the first entry point for having access to different kinds of financial services. In the region, in the Western Balkan region, 75% of men have access to accounts, and for women there is a 10 percentage points gap, that is 65%. Concerning the second indicator, access to the credit, latest financial access survey of the IMF clearly indicates that men continue to dominate the credit portfolio. Despite some progress, women remain underrepresented with around 45% of the credit portfolio. This share in the Western Balkan region is even lower, somewhat below the world average, and in some countries in the Western Balkan region, it goes down up to 1/3 of the credit portfolio. And what is even more important, I think it was already touched upon on some of the previous panels, we have data shortages. In fact, now we are focusing with this data that I demonstrated on the household portfolio. We don't have consistent data on the corporate portfolio, where the gap may be even bigger. And I think we all know, it is well established that access to finance is one of the key preconditions for entrepreneurship, including the female entrepreneurship, as this segment creates around half of the world GDP and employs about 2/3 of the global labor force. However, unfortunately, statistics point that just 20% of these enterprises are led or owned by women. Thus, it doesn't come as a surprise to have studies which point that increasing or using this unused potential can even increase the world GDP by around 5 to 6 billion trillion US dollars. This is equally relevant for the Western Balkan region, as according to the EFSA survey, the share of women-led or dominated business ranges from 17% in Kosovo to around 33% in Serbia. In our case, it's around 23%. So why we see this finance gender gap still existing, although, as I mentioned, there is some progress. Obviously, a set of complex factors is at play, including legal, regulatory obstacles, including social norms, stereotypes, and so on. But one factor that deserves to be in particularly underlined, I think, is generally low participation of the woman in the society, in the economy. For example, in the Western Balkan region, activity rate of women is only 45%. This means that the half, practically, of the woman potential has been actively, productively used. Just to compare with the EU, where this rate is 75%, but this is also significantly below the rate of activity of men in the Western Balkan region, which is 65%. Practically, we're speaking of a gap of around 20 percentage points. And in this region, I think this question is very relevant also because of the structural problems that we are seeing, which is shrinking labor force, reflecting two factors: adverse demographics and emigration. So if we are faced on the one hand with shortage of the labor force, and on the other hand, we have practically used just the half potential of the woman, obviously there is a huge benefit to more actively involve women in the society. In fact, World Bank study points that closing this gap or narrowing it can lead to 18% higher GDP in the Western Balkan region. So, in a nutshell, increased financial inclusion of women can have indeed non-negligible effect for the society. It is not only about fostering gender equality, which of course is a basic democratic principle, but it's even more for macrocritical effects, higher growth in our society, and even more important, inclusive growth, which will help also facilitating the problem with poverty. I will stop here for now.
Well, thank you very much for this very enlightening problem analysis so far. Let's not waste too much time and just continue and invite Governor Irena from Central Bank of Montenegro. How relevant is this for you? Can you share from your perspective on the challenges?
Thank you very much, Alfred. First of all, I would like to say that I would very much like one of my male colleagues to join me here on the scene, because I believe that financial inclusion, talking about relevance of gender inclusion, is a general subject of interest to all of us. I will refer to one of the arguments used by Anita when she was eloquently presenting the situation in the Western Balkans. I'll refer to a study conducted by the IMF and presented in January 2024, which relates to my country, Montenegro, a country which is aiming at negotiating with the Commission to close accession negotiation chapters by 2026 and start the ratification process for acceding the European Union in 2028 as of 1st of January 27. Well, that study showed that elevating the participation of women in labor force in Montenegro to 75% of participation of women in labor force in adjacent countries. I'm talking about Croatia, Bosnia, Serbia, Kosovo, and Albania, would elevate Montenegrin GDP by 6%. So I come from the most traditional country in the Western Balkans. I'm the first woman at the helm of the central bank and first woman in the recent history at the helm of any important institution. So the shoes of a female president, prime minister, minister of finance, well, speaker, any position of power, apart from the position of the central bank governor, which I have the pleasure to currently perform, remain yet to be filled. I will agree with my colleague from Serbia that there are strong societal norms and traditional obstacles, but I will strongly disagree with the fact that not much remains to be done and that we don't need quotas. Prior to becoming governor of the Central Bank of Montenegro, I was at the helm of the National Development Bank. When I came into the institution, again, I was the first ever woman to lead that institution and first ever woman to integrate the supervisory board of the institution and management of the institution. When I entered the institution, I was one out of 6 in management and 1 out of 5 in the board of directors, and I had 15% of loans extended to women in overall credit portfolio of an institution which is there for over 30 years. I worked very closely with colleagues in other development banks, with some of the European decision makers. We pushed forward for significant legal reforms. And then the fact that we had such a low proportion of women's micro, small, and medium enterprises supported by the development bank actually led, in combination with some further incentives, to doubling the percentage 3 years later when I left the institution. When we realized that it's not only the micro, small, and medium enterprises segment, but in the large enterprises that women account for less than 5% of positions in management and in boards of directors, then we went for accommodation of the directive on European Union directive from November 2022 on more balanced representation of gender, which allows for, well, which prescribes minimum 40% in board of directors of the less represented sex and 33% at executive levels. And now Montenegro is champion in that segment too, but it doesn't mean that we've come far, because ultimately, even when you have quotas, they're not honored, and it's not an issue of meritocracy. In Montenegro, 60% of graduates over the past decades are women. They perform better in universities. But when it comes to occupying key positions in any sector, including the financial sector, they are virtually absent. Over the first 10 months of my governorship, I didn't have a single woman which was in charge of a single commercial bank in Montenegro. After negotiations with the banks, we managed to elevate the number of women in supervisory boards, again, thanks to reliance on EU directive. But then again, it's not an issue of meritocracy. It's simply tradition and norms which translate into business environment. So I believe that we do need to play an active role, all of us, and I do believe that when working, especially in international financial institutions, in regulators, that this is a question that needs to be posed. And we need to address it because it's not an issue of equality, it's an issue of inclusive economic growth and of balanced development of the entire society. I believe that now when I'm in the position of a central banker, that the chance to do more and chance to be an agent of change has increased even further. I'm sorry that Francis Malige left, but he played a very important role in Ukraine in the period of 2014 and later, when he was one of the agents who established Women's Business Academy and established support for micro, small, and medium enterprises. But then again, as regulators and supervisors, we have even more of a pronounced role, and we have a variety of mechanisms. And I believe that some of the initiatives that we are taking in partnership with the EBRD, I very much hope soon also with the EIB and ECB, can actually lead to change in our region, which again, as it was put very eloquently this morning by my dear colleague Boris Vujicic, again has a leg, and we cannot put an equality sign between advanced economies based on strong and firm democratic principles and emerging economies which are still in transition. So there are many aspects that I would wish to address. There are many segments where we are undertaking work, but then again, I believe that the rest of the panel will serve for that. So back to you, Alfred.
Yeah, thank you very much also for sharing your personal impressions around this topic. I'm also grateful that you touched briefly upon the issue on female leadership, especially in central banks. I remember we went to Marrakesh last year for the annual meetings, and we had a really great top-level discussion around female leadership in central bank, invited by governors from Central Bank of Spain and Morocco. And I can tell you, with what you have been sharing with us, we are actually not alone. There is a very strong, I think, move towards recognizing these issues on the global level in our community. But let's go back to that question, how relevant it is and what are the main challenges. And I would like to invite Governor Jasmina from Central Bank of Bosnia-Herzegovina to share her views with us, please.
Alfred, thank you very much. So good afternoon to all of you. I would like to thank the organizers for the opportunity to be here and to share those views with you and to share the floors with my colleagues, governors. I cannot agree more with everything that has just been said by all previous discutants. Actually, it's a very important, let me refer back to what Alfred mentioned at the beginning. It's not related to women. It's not a women issue. It's a just gender equality. It's related to inclusive growth. So this is usually the trap that we usually fall into. So it's very important to underline that at the beginning. If I focus just on Bosnia and Herzegovina, according to the last data that we have by the World Bank Global Findex database, we can see that 70% of women who are 15 years and older than that have accounts in financial institutions. And Anita mentioned that the average for the Western Balkans is 65. So it doesn't mean that we are good enough, so we are just above the average, a bit above. But it's still a huge way ahead. There are still a lot of things that need to be done. At the same time, if we compare this data with the data 10 years ago it was 47%. So in 10 years, from 47 to 70. So obviously, there is some progress, but I believe that the time for acting for the future activities is really now. So we shouldn't be postponing the further actions or the further discussions in this sense. However, if we talk about if we compare this number with some other benchmarks, if we talk about the men accounts ownership in Bosnia and Herzegovina, the percentage of men is close to 89%. So 70 women and 89 men. At the same time, if we compare Europe and the Central Asia, the women ownership, it's 88. So we are below the wider region average. The second thing which I would like to point is a labor force participation rate in my country, which is 40% for women and 60% of men. So we are talking about disparity of 20% just in the same case. As Anita mentioned, it was 45 and 65, but actually it's very close. We all know that without that, any other more sophisticated access to financial services, it's not possible. Not having the woman, this labor force participation is intrinsically linked to financial inclusion, because without that, if they don't have access, we definitely cannot talk about the higher income or any other things as economic stability, economic growth, or independence. If we think about the causes of this, then definitely we are also very traditional, Irena, I would say. Let's put it politically correct. We have a lot of cultural norms. We have gender stereotypes. We still have a lot of stereotypes that are geographically related, especially linked to the rural areas. So in that sense, I believe that the central banks should play very important roles. Of course, not just alone, because it's not possible, but we should use all our power and communication with other relevant stakeholders, such as the governments and the civil society, in order to move these numbers on the higher level. In my previous life, I was a dean of one high school institution, of the biggest high school institution in my country, and I can say that 15 years ago or 20 years ago, the percentage of female professors and the percentage of female leaders in my society was very, very low. It was just over and there. It was possible to see a female leader. Now the situation changed, especially in some very specific areas, such as social sciences, business, and the finance. But as I said at the beginning, it's still huge way ahead of us. I would stop here for now.
Well, thank you also thank you for sharing the data. Obviously, what we have heard up to now, the access gap seems to be relevant for us. And we haven't even started talking about how these services are used and what kind of quality these services have. So I think we will have another round when we talk about what can be done. But let us also bring in our virtual participant, Governor Anka Dragu from the National Bank of Moldova. So I would like to ask you as well the same question on the relevance, but in order to already close the loop to the second question, perhaps you also want to share with us what can central banks actually do in facilitating effective collaboration to create more inclusive financial ecosystem for women. Thank you. Anka, the floor is yours.
Well, thank you, and thank you so much for accommodating my participation online. I'm very sorry that I'm not here with you for this so important debate, but I talked to Anita the other day saying that, well, I would very much like to be with you even online, because yes, that's a very important topic. And when I took over this position, I soon learned that I have strong allies in the region. I found wonderful women governors in the region, the one that are now in the panel. And we started to talk about common strategy for all of us. Across the world, around the world, there are no many female governors. There are only 29 female governors out of 185 countries in the UNFIF report we have. So this is that's why very important to really team up and to make sure that financial inclusion, it means that it's a gender inclusion, financial gender inclusion, yes. My colleagues already put forward many figures, and so it's not the moment to go back to figures now, but let's look a little bit about reality. Lesser access of women to financial services means also somehow not alleviating gender violence. You know that gender violence in general is not only about physical violence, but it's also economic and financial violence. So this is why it's very important to make sure that everybody, women, have also access to financial services as men. Also, it's my belief that when we're talking about leaders in finance, it's important to have the perspective of both men and females, because this is how our society is complete, yeah? How we make women participating more in leadership roles. First of all, we have to make sure that the society is accommodating our needs. We all know that, we do take care of our families. This is very, very wise for societies to make sure that they take care of our families as well. So societies provide good childcare services, provide good services for taking care of elderly people. Otherwise, they all come on our mandate, you know. So this is why, looking a little bit from a broader perspective, I've been always pushed for more female participation in politics. This is where women could have a stronger voice in order to make possible all these public policies that would help women get more integrated in their jobs, including in finance. Yes, finance, it's a relatively tough area, but it's not the fact that we cannot be good in finance. If we talk about meritocracy, and everybody spoke here that yes, we do have a good rate of participation in higher education, but then it's a sort of a tax on maternity that at some point we pay, maybe, yeah. And also it's a little bit of courage. What we can do is really to support each other. At the Central Bank of Moldova, we are in a very good position. We have the governor, female, yes, and we have a vice governor. And there are other 3 colleagues in the executive board. So we are 2 female and 3 men in the executive board. In general, in the bank, there are almost 70% women, 65% women. At board -1 level, we are equal, 12 men and 12 women in role of directors. Well, if you want to look at the parity, it should be a little bit higher number of women directors, but yeah, okay. We are looking. We look happily at this fair, equal share of men and women at directors' position. We do have a program at the Central Bank of Moldova to support women having a balanced work-life balanced activity, and also where we support them to integrate when they come back from maternity leave. And in Moldova, maternity leave could be up to 3 years. So it may be a little bit difficult for a female to get integrated after that long period of time. I think at the regional level, we have to team up and to encourage girls' participation in finance programs, in School of Finance, and also women's participation and access and mentoring to access managing positions. Yes, it may be challenging, and there are so many studies showing these differences in approach between men and women. That's why I think for us, those who are now leaders in finance, it's our responsibility to help our colleagues to make the step and to join the club.
Yeah, thank you very much for your contribution, and greetings to Moldova. Well, let's maybe close this this discussion by maybe this time starting at the very far end. Yasmina, my question indeed is again So what is the role of central banks in this? What can be done, and what is your experience here?
Thank you very much for the question. Actually, you are just referring to what I just said. It's a really time for action now, and I believe that the power that we have as a central bank should be used in that direction. Since we recognize the lack of data in Bosnia and Herzegovina, we just started the project related to gender disaggregation of data, because if we don't have the proper data, definitely we cannot come with any specific conclusions. So this is the first step in this sense. It is not only about the data collection, it's about understanding what the real problems are and how to target them in the near future. If we take a look at the broader picture, I believe that each country needs one sort of hub as the institution which will link the civil society, the government, the financial sector, or any other relevant stakeholder in this process. So the Central Bank of Bosnia and Herzegovina will try to serve as a hub to connect all those stakeholders and to try to make informed financial decisions, to create tailor-made programs for the particular sensitive groups. Also, the use of digital financial services is something that can be the program for the future. But at the same time, it's very important to underline that all those activities need to be organized very carefully. We need to be able to monitor them and to measure. Otherwise, any success cannot be, it shouldn't be just taken for granted.
Thank you very much, Governor Irena. From your perspective, what do you see as a task for the central bank in order to lower not only the access gap, but perhaps also to increase the level of quality of these services for women?
Thank you very much. Again, earlier today, I think it was Gilles Noblet who was quoting Charles Goodhart and talking about societal accountability. And he was talking clearly in the context of central bank independence. I'm talking about societal accountability in terms of financial inclusion of vulnerable groups. And here I'm not talking only about gender. I believe that central banks have a role to play in this particular regard. Sometimes we have to slightly go outside our remit. When it comes to the scope of activities that the Central Bank of Montenegro is undertaking, I'd like to say that over the past 10 months, we have engaged and already implemented the memorandum with the National Statistical Bureau and with banking institutions, and as of recent with non-banking institutions that we also supervise, the methodology and putting in place the mandatory collection of sex disaggregated data, which is very relevant and which showed to surprise of our authorities that women-led enterprises and women-owned enterprises account for only 1.19% of percentage of loans which are underwritten in the credit registry portfolio. So essentially, when we're talking about, again, deposits, we have participation of women at 24% compared to men. So we have also one particularity which is more pronounced in Montenegro than it is in the rest of the Western Balkans, which is ultimately something which is credible, sounds incredible today and very, very sort of intangible, which is the very strong social norm according to which women don't inherit. Today, a woman with a PhD from international university living in Montenegro, based on the survey which was conducted 3 months ago, is most likely to say no to inheritance because she would be perceived negatively by family. So essentially, this leads to the fact that you have a problem with collateral, problem supporting and well, getting a loan to support your business. And the Central Bank of Montenegro is very much involved in a number of campaigns, and we're working very closely, as I already mentioned, with the EBRD. Basically, I had a very interesting experience 2 years ago. I was sitting on the National Competitiveness Council, and this is the Competitiveness Council where the Prime Minister and all economic ministers sit. So I was advocating the transposition of EU directives on balanced representation of gender in large public and private-owned enterprises. And at some stage after my introduction and after advocating, well, how much it will bring to Montenegro in terms of credibility and, again, how much it will translate into economic growth, my colleagues back then, Minister for Economic Development and Minister of Finance, raised their voices and they said, but Irena, this is going to be a business obstacle. Where are we going to find these women? We don't have sufficient number of women to make them 40% of the board of largest private and state-owned companies. So at some stage, I said, well, let's wait until the next Competitiveness Council and I will find a way to have those women. So I went to the EBRD, I talked to Francis and Barbara, we started Women on Boards trainings, we recruited the best batch of 30 women, we designed a program for 3 years, and now when I'm at the Central Bank, I am now working from the Central Bank on the same program, and we are now seeing the second generation of women who are offered financial leadership, number of, well, communication and a number of skills which will help them take more active role in financial and economic ecosystem. When it comes to... Thank you. When it comes to Central Bank and what we are trying to do in the Central Bank of Montenegro now is actually to promote different programs for increasing female financial literacy. And it's especially pronounced in the digital domain. And currently we are partnering with our scientific community and with digital startups to actually make headway in this particular segment. I believe that there is also a role for central banks to advocate legal reform beyond what I've described now, and to actually implement gender-sensitive policies and regulations to narrow the gender gap in financial inclusion. And I believe what you are doing globally, and I had a chance to flick through the programs and achievements of the past days, is something where I will very gladly subscribe. Because I believe that it is a very important part of the mandate of the central bank, even though one normally doesn't define it as such. And again, an additional segment is promoting not only institutional diversity, but also sectoral diversity. In my society, women prove to be very risk-averse. They tend to opt for public sector. And when you have a look at the structure of the central bank as opposed to industry, finance as industry, you will see that over 60% of employees of the central bank are women, that 43% of them are at medium leadership positions, management positions. Currently, it's 100% at the level of management because I'm the only one who has full term in the central bank. I'm missing my vice governors and non-executive members of the board, but this brings us to the central bank independence, which I shall not open. And currently, when I joined the central bank, I was among 2 out of 8 in the supervisory board. When you flip the coin, and when you look at the industry, in managerial structures, there's below 15% of women, none at the helm of a single banking entity. And in supervisory boards, only in EU based banks, well, ECB supervised, I have 4 of them out of 11. We have 40% of women on boards. In other remaining 7 banks, we have none. So basically, it's very important to understand that we will have a better perspective, we will reach better economic decisions, we will take care of risks in a better way, we will invest in just transition in, again, more responsible way if we do it together. And I believe that central banks do have a significant role to play, and also sometimes, given the fact that when I communicate with my fellow colleagues, central bank governors in the Western Balkans and the wider region, there is a very strong sense of solidarity. And there is excellent communication which is in no way tarnished by political, ethnic, religious, or any kind of burden which normally burdens our politicians. I believe that we as a community have a strong role to play in leading the society forward and becoming the role models for the society and for the institutions in our systems. So I would like to use this opportunity to say that we believe in our partnership, but we also believe in partnership with you, the representatives of international financial institutions, the media, and all the stakeholders, because it's very, very relevant to understand the power and advantages that a central banking community can bring to the wider system. And at the same time, as I did try to pass it through my question, which I asked today earlier, I would like to say that judging not from my personal perspective, but judging from perspectives of all of us, governors from the region, I would like to say that the IMF plays particularly pronounced role in safeguarding not only central bank independence in the region, which is very frail, but also in pushing the inclusive, green, digital agenda forward. And I very much believe if we are talking about accession countries, and if we are talking about my country completing accession negotiations in 26 and joining in 28, which is currently the Commission's plan, that it might be more prudent to get engaged now than 2 years after we join the European Union. I believe that is also to the benefit of all of us, and to the benefit of positive forces and strong forces in our societies that have the potential to lead the societies forward. And financial inclusion is definitely one segment that cannot be ignored. Thank you.
Thank you, Irena. So much to say. Unfortunately, not enough time. Therefore, Anita, we are quite familiar with what the National Bank is doing in the space, but perhaps you can share with us and maybe also touch a little bit upon the work that you do around digital financial services. I think that plays quite a role in this context. Thank you.
Okay, thank you. It will be difficult to squeeze all this in 2 minutes, but let me try to highlight, I think, most important things. Let me start by saying that according to the World Economic Forum Gender Index, the progress in gender finance and in gender inclusion has been particularly slow in the recent years, reflecting, among other things, the fact that the recent crisis has disproportionately affected women more than men, and that if we continue with the same policies and with the same pace of the progress, it will take us 131 years to close the gap. So it's clear that focus on these policies is inevitable. However, it's also a fact that significant part of these activities are outside the perimeter of the central banks. But still, I think, as my fellow governors mentioned, there are many meaningful things that we can do to contribute. Let me mention 3 of them. First, I think we can lead by example. Central banking community is a man-dominated community, where, as Anka mentioned, less than 20% of central banks are headed by women worldwide. However, I'm glad that our region is a positive outlier. Out of 6 Western Balkan countries, 4 are led by women. Our central bank 2 times in a row was ranked as #1 in the world, having in mind the participation of the senior management in the women participation in the senior manager, which accounts 70%. Of course, needless to say that the gender is our guiding principle. We fully comply with a merit-based system, but in the same time, we take care that we create conducive environments for higher participation at the women. Second, as my colleagues mentioned, we also are undertaking a lot of activities in the financial literacy segment, because having the OECD survey of the financial literacy in the Central and Southeastern Europe, we are still significantly lagging behind the EU, and the gender is visible on average around 6 percentage points. Third, as it was already mentioned, and I believe it's a very important fact, gender disaggregated statistics. It's key for first accurately identifying disparities, calibrating, but also reassessing the policies so that we are sure that our policies are effectiveness. So against this background, we, as Irena mentioned, are also cooperating with the EBRD, and we recently signed a memorandum in which Central Bank will be coordinator for the domestic economy for promoting female leadership and better access to finance. Also, not to forget to mention AFI, institutions such as AFI, who can also play an important role in promoting the financial inclusion. And last but not least, although personally I'm not a believer in quotas, having in mind the environment in which I professionally grew up, where gender was nor advantage nor disadvantage, but still, if we are living in societies in which progress is obviously taking place but very slowly, I still think that some regulatory actions, be it in the form of quota or regulation, can be conducive to better environment. In this context, and having in mind especially the participation of the women at the management boards in our financial system, where on average share is 1/4 roughly, and especially having in mind the fact that almost half of the banks in our country do not have female representation at their boards, we have drafted the amendments on the law on the banks and submitted to the Ministry of Finance for review, in which we incorporate EU Women on Boards Directive. So overall, let me finish because of the time, just to say that women represent half of the world population, meaning half of its potential. Unfortunately, only 47% of women globally are actively participating in their society. So continuing with these policies must remain one of the priorities of all policymakers. Thank you.
Yeah, thank you. That's great. No, thank you. Thank you so much. Our time is up, so I will not summarize these discussions. And I'm pretty sure that some of the male leaders out there can't wait to raise their hands and to make a contribution. We have to postpone this to one of the next occasions. I'm pretty sure there will be one. As I said, I'm not going to summarize. I just would like to say that this was very inspirational. I think you're in a very good company. We do quite a number of these discussions, and I feel very familiar with the topics, and I think we are very well positioned to drive these changes dynamically forward. I'm looking forward to being part of this. I feel very privileged to be part of such a great group of personalities here on the panel, and I would like to thank you for your leadership. Thank you very much, and enjoy the rest of the sessions. Thank you.
Thank you.
Dear guests, please join us at the coffee break in the lobby. gentlemen, dear guests, please join us for the concluding conference panel, Stock-taking on the most recent crisis episode, Lessons learned and the way forward. We kindly invite the moderator and the panelists to take their seats on the stage.
Good afternoon. It is my pleasure to welcome all of you to the final part of this conference. Let me first say that I have found so far the conference fantastic, with excellent discussions, speakers, and I'm sure this final part will live up to the same standards given the fantastic speaker and panelists that we have. So before going to the panel, I have the real pleasure to introduce the next speaker, Gianmaria Milesi Ferretti. Gianmaria is a senior fellow in the Hutchins Centers on Fiscal and Monetary Policy at the Brookings Institution, and also a former colleague at the IMF, where he was deputy director at both the research department and the Western Hemisphere department. He has also published extensively in top academic journals on international macro and international finance. So Gianmaria will talk about the recent episode of global inflation, the forces driving the surge in inflation, how policies responded to the different shocks, and also some differences across regions. So without further ado, Gianmaria, I'll pass the floor to you.
So good afternoon. Let me start with thanking the National Bank of Macedonia, Governor Anita Angelovska, for her kind invitation to join this event. And it's nice to have old friends here on the podium. Sebastian and I go back a while, and with Deborah and Dubrovko as well. What I am going to talk about today is just a bit of stage setting on the recent inflation episode after the COVID pandemic, with a focus on what has happened in emerging economies. And just not to claim credit for things I did not write, I will refer and base my remarks on the outcome of a conference we organized at the IMF on inflation in emerging economies in April, as well as a lot of work on the subject, paper by Bernanke and Blanchard on the United States, and a follow-up volume that covers a lot of individual country experiences with many of the central bankers involved writing about these issues. So clearly, from the point of view of emerging economies, you have a lot of common elements in this inflation episode, and given the relative size in the global economy, you really can talk in most cases of a sequence of completely externally driven shocks affecting, very importantly, the inflationary outcome. And these shocks were of a different nature and sequential, and really build up the inflation repercussions over time. you had food prices rising. And we know that for emerging economies, developing economies even more, food prices have actually a higher weight in CPI, so you have mechanically a bigger impact of an increase in food prices on headline inflation. Then energy prices arose starting a bit later in 21 from the depth to which they had fallen in 2020. And then, of course, you had a second stage with the buildup of tensions between Russia and Ukraine, and then the Russian invasion, the start of the war, with dramatic repercussions, particularly on gas prices, but also on food prices. And then you had the supply chain disruptions that were a consequence of the pandemic, but also a consequence of the pandemic-induced rebalancing of demand towards goods that implied all of a sudden that supply chains could not cope with much additional demand for certain types of goods. All these factors are really global in nature. You have some heterogeneity domestically caused by the fact that countries had a different pace of recovery of domestic demand, which depended a lot on how much money the government put on the table, really, in terms of stimulus. But still, overall, the sign was clearly an expansion, and that was common across countries. So I'm going to talk about what has been different, and not just about these common elements, and I will try to distill how these differences came about, despite, as I said, the global nature of the shocks. And it is the description of the shocks themselves, if you think about it, that suggests why the impact is uniform in terms of direction. Qualitatively, it pushes inflation up, but quantitatively, the repercussions change across countries. And food prices are a very good example. I will show later the differences between emerging Asia and emerging Europe and Latin America. And one of the dividing lines, if you want, is really rice versus wheat. Wheat prices got hit very heavily by the war, given the importance of both Russia and Ukraine in wheat exports. Rice, which is important in food price baskets in Asia much more than elsewhere, had instead much more contained pressures. In some cases, you had even export bans that helped keep domestic prices lower. Energy prices, we were schooled with energy price shocks that were truly global. Oil prices, there are some differences across countries, but fundamentally oil is a traded commodity. Of course, there are exporters and importers, but prices go up for everybody. Gas is different, and the differences that arose in gas prices across continents were truly staggering after the beginning, actually starting before the beginning of the war, and then getting into it. And these large differentials affect, obviously, countries across continents and even within continents in very different ways. Also, countries handle energy prices differently in terms of their own domestic policies. Some countries have subsidies, some countries have price controls, and some countries decided to step in to reduce the impact on consumers of rising energy prices. And again, this drives a heterogeneity in the impact of the inflation shock. And finally, you have exchange rate dynamics. You have differences in exchange rate behavior, which in some countries, which are particularly open, matters a lot in terms of what the repercussions for domestic prices are. So let me start briefly on Latin America, just to say, because this is really the first region where the tightening really started. And the response was way faster than it was in advanced economies. And there were a number of reasons behind the faster policy response. And one of them was really exchange rates. Exchange rates had weakened quite a bit in Latin America during 2020, and policymakers were really concerned about these expectations, this depreciation feeding into prices, and also about the fact that you had supply chain difficulties and at the same time some boost to domestic demand coming from the recovery. Policymakers still had a memory of inflation expectations having weaker anchoring than in advanced economies. All these considerations militated in favor of starting a tightening cycle earlier. If you look at emerging Asia instead, I have a chart over there. It's a spaghetti jumble. Don't look at individual countries. Just look at two things. One is the scale, and the other is just the overall shape of the lines. You don't see a clear common cycle. You see some elements of it, but not that much. And you see inflation really relatively contained by the standards of the episode across the globe. And here again, currencies not depreciating much, energy prices having a lot of administrative pricing, domestic demand lagging. Remember 2022, which was when many prices skyrocketed, had China still closed, and many countries with more limitations to movement of people, so delayed domestic demand, more modest food price increases, more controlled energy prices, and this was the outcome. If you instead move to Latin America, if you look, the pattern of the uniform pattern is striking visually. Of course, there are differences in the intensity of the shock across countries. You had some countries, Colombia, Chile in particular, pushing harder on domestic demand, and you see different intensities of the inflation episode, but very much more of a common cycle. And if we move finally to this part of the world, I'm plotting data from the HICP, from Eurostat, just for uniformity across countries. You clearly see the similarity of the qualitative pattern of inflation. Within that similarity, a lot of differences, though, in terms of levels, at the bottom, Albania, and at the top, Hungary. And again, you can tie these differences very closely to what has happened to the underlying shocks. So I'll just show you, let me actually highlight here the scale again, particularly if you compare to emerging Asia. We have a scale running up to 25 as opposed to below 10. And if we move to the individual components, you look at energy, you see countries with energy prices going up by 40%, but other countries, again, Albania being a good example, having less reliance on imported energy, no reliance on gas, which kept energy prices contained and helped having much lower rates of inflation compared to some of the others. I don't have the Baltics here. They are within the euro area. Clearly, countries very, very heavily affected by rising gas prices through the impact on electricity, among other things. And food, you can also see very dramatic developments across countries with Hungary really topping the chart there. So common elements, but heterogeneity because of different sensitivities to the shocks. What does that tell you about how central banks reacted? Well, a lot of what I said has basically been abstracting from policy reactions. Why was that? Because I think the triggers and the magnitude of the inflation episode were very much driven by shocks rather than by monetary policy. Monetary policy was very important in the reaction. I think the title of the conference is extremely appropriate. Central banks had to demonstrate commitment and preserve credibility. Why was that? Because the supply shocks, which you should normally see through, were so large, so repeated, that they would clearly have some second round effects, and it became essential for central banks to contain, to anchor inflation expectations, to show their commitment to preserving credibility, their commitment to returning inflation as these shocks waned to reasonable levels. It did. Clearly, the waning of the shocks was again the main factor, but central bank policies were very important in ensuring that inflation expectations again remained well anchored. There may be a last mile problem. There is clearly some catching up of wages. Real wages fell in a lot of these countries. Some catching up in nominal wages is still going on. Clearly, vigilance remains essential, particularly for central banks where you have less exchange rate flexibility and where undoing an unwanted appreciation is particularly costly. But I will leave it at this for now and happy to continue the conversation during the panel. Thank you.
Thank you, Gian Maria. Excellent presentation. And I think you have really set the stage very nicely for our panel. The panel's topic is precisely to do a stock taking of the recent crisis episode, trying to derive some policy lessons and also discussing the way forward. So as Gian Maria clearly showed, the recent inflation spike was a global phenomenon that affected some regions differently. There was a series of successive shocks, supply, demand shocks, which affected also sectors differently. I would also say that the unprecedented fiscal and monetary policy stimulus deployed both in advanced economies, but also in some large emerging markets to contain the economic impact from the pandemic, initially increased savings, but over time, boosted domestic demand, which exacerbated some existing imbalances between supply and demand, and of course fueled further inflation. And in response to this surge in inflation, central banks across different regions tightened monetary policy sharply, in some cases to a degree not seen in a long time, including in Europe, in the US, but also in many other regions, including emerging markets. And given the nature of the shock, but also given the uncertainty about their effects on the economy, and also given the intention to prevent scarring from the pandemic, it was quite challenging for central banks to calibrate both the timing and the pace of monetary policy responses. So the good news here now is that inflation has declined in most countries, although in some regions, in particular in some emerging markets, core remains relatively high. But we have seen inflation decline across most countries. So I think this is really a good time to take stock of this experience of the last few years. And I think this panel will try to discuss and to shed some light on the main lessons that can be learned from this episode, and also provide some insights on the challenges for policymakers going forward, and in particular, challenges coming from some post-pandemic structural developments that can affect and influence monetary policy going forward. So to discuss all these issues, we have now a distinguished panel today. Let me quickly introduce the panelists. So I will start next to me on my left with Ahmet Ismaili, the governor of the Central Bank of Kosovo. Next to him, we have Simona Skrepsta, the board member of the Bank of Lithuania and member of the supervisory board at the ECB. Deborah Revoltella, director of the economics department at the European Investment Bank. Gian Maria, which I already introduced. We have next to Jean-Maria, Jeff Vox, Senior Advisor in the Economics and Research Department of the National Bank of Belgium. And further to the left, we have Dubravko Mihaliek, member of the Audit Committee of the Croatian National Bank. So let me start by asking all panelists about, to reflect on precisely on the lessons from this recent global surge in inflation that Jean-Maria very nicely described. So a number of questions come to mind, at least to me. For example, how did central banks across the globe respond to the new challenges that they were facing? Did the global nature of the policy tightening made a difference? What lessons can be drawn for monetary policy going forward? So let me leave you with these questions first, and I would like to start first with Governor of the Central Bank of Kosovo. Hopefully you could also provide a perspective from the CBK and also bring in a regional perspective. Thank you.
Thank you very much, Sebastian. Dear colleagues, let me first thank the organizers, Central Bank of Macedonia, with the Reinventing Bretton Woods Committee. I can say that we enjoy excellent relations in the region, and we benefit a lot by exchanging data and discussing those issues. I have to admit that the IMF was the one to really support us during those very difficult times. So you deserve as well a recognition for the support, but not only the other institutions, including European Union. So let me say that even though this issue is not totally, as you said, as the presenter was saying, we are probably at the last miles, but however, we consider that we have been successfully navigating through those challenges during the most recent economic crisis, global crisis. It was pandemic, energy crisis, and then the war in Ukraine. In the middle of those, some other countries had some elections, so just imagine how complex that was. But particularly those related to economic disruption caused by inflationary pressures, supply chain bottlenecks, economic impacts from the tightening of the monetary policy, and of course, as a small and open economy, we are very much dependent on the global trends. The structure of the issues and the economy structure as well is very much connected with we are dependent on import. That's why we have been very much and directly connected to the global developments. As it was said, the inflation has surged to levels that has not been seen in multiple decades. And the reasons have already discussed: a strong recovery from the pandemic on demand side, supply chain disruption, commodity prices, and of course, exacerbated by Russia war in Ukraine. What we have seen from during that time is that, of course, data were crucial. So I think we all agree that we were unprepared with necessary information on the data when it comes to policy-based for the decision based on the data. So I think that was one thing that we learned, and I think we are working to be prepared. Our banking system has been sound and resistant to those challenges, and I think that has demonstrated that even though there were multiple shocks, we were able to respond. Then the central bank has played an important role by using the right instruments. It was proactively engaged on different measures, and I'm going to elaborate further. Economy now is stabilizing after contraction by 5.3% on 2020. Then a strong recovery, 11% on after the pandemic. Then a stable growth by 4% is continuing. The inflation has from 11.6% come to 4.9% last year, and now 2.1% CPI, and core inflation 3.7%. So we believe that we are going toward a projected target of 2.5% for this year. We have advanced a little bit on financial intermediation, which is now 50%, a little bit better on a business and SME rather than individuals. And we don't have any, for now, any pressure on aging because we have a relatively young population. 70% of our population is less than 40-year-old, So with an average of 34-year-old, the entire country. So inflation was, the one that is still had an impact, and as we are dependent in imports and our diaspora is very much on European countries, Germany, Switzerland, and our main trade partner of Kosovo is European Union. We have been, of course, very much connected, and out of 4.9% inflation rate last year, 4.1% was imported inflation, and 0.8% was percentage point was coming from internal pressures. If I just speak a little bit the instruments that the central bank has, of course, as a unilaterally eurized economy, we have a limited tools on a traditional monetary policy tools, but however, we had a minimum reserve requirement and some capital-based measures, borrowed-based measures, and other liquidity-based measures, which unfortunately there was no need to activate, fortunately. But however, the central bank was closely monitoring and taking the proactive measures on dialogue on a monthly basis, meeting the credit risk officers by our Department of Financial Stability and the Bank Supervision Department to make sure that we know what is happening and what measures has to be taken. An NPL ratio, it's at good level. Now it's 2.1%. Historically was good. Profitability of the banking sector is as well at high level, and an average of 20% on return on equity, with good capital adequacy ratio and liquidity ratio as well. During the pandemic, of course, there was a need to restructure some loans, so it was doubled, the total loans to be restructured from 2.4% to 5.5%, and later on again, it is at 1.2%, so it has been successfully addressed. Some of the measures that the central bank has taken was, as I said, supervisory dialogue, so knowing what is exactly happening. Then it was dividend policy limitations, loan moratoria. So for especially that short term, for up to 6 months, it was possible that you somehow reorganize your payment schedule, so you make sure that at least the liquidity is there and it's not going to be a burden. That happened just after the March, when the pandemic started, April, May. And it was a right approach. It was flexible in terms of NPL requirements. Central bank closely cooperated with the Credit Guarantee Fund. We had a fund which was then, they cover 50% of the risk of the loan if that's going to default. That was increased to 80%, and the IMF was as well consulted on this. So that is, of course, zero weighted when it comes to weighted assets. On other hands, there was good alignment with fiscal authorities when it comes to the stimulus measures that the mainly government Ministry of Finance has taken. So I think that was as well very much important. What we have learned, of course, that data are important, and we are working intensively to make sure that we collect and analyze those and prepare decisions based on those information. Early identification of emerging vulnerabilities is one thing that we are, of course, considering as one of the lessons, but of course systemic and cross-segmental monitoring is important. We have enacted, and now it's very active, the macroprudential committee, where we discuss issues and make sure that we have a proper, let's say, instruments into place. In addition to that, what we are doing and how we are way forward, we decided to implement the capital buffers. So we have introduced the countercyclical and systemic buffers. We have increased the deposit insurance fund premiums, which since 2016 have not changed, even though there was the bank sector has evolved and the profits now are doubled. So from 1st of January next year, the new rates of premiums will be applicable. We are cooperating closely with Credit Guarantee Fund, and we are reviewing what else can be amended on our legislation when it comes to supporting the growth. We are harmonizing the regulatory framework with the European Union legislation and Basel standards. We are enhancing the credit registry with a lot of data, including the gender, but not only some other indicators that will be used later if we decide to, by any chance, take borrower-based measures. So we are going to introduce a lot of new data, including the incomes of the borrower, co-borrowers, the value of the collateral, the immediate price of it, I mean, the haircuts that are applicable, etc. And we have enhanced our interagency cooperation because we are aware that the crisis cannot alone, and we are, even though we are a very important institution, we are not the only one, and the financial stability and entire economy is much more complex. We are testing our stress test models and capacities and capabilities as well. Those are the measures that we are taking, and together with IMF support, we are helping the Agency of Statistics on a household index prices. So that was for different reasons is important for us. And we just signed an agreement with them to be much more aligned when it comes to data, exchange of data. So I think what we have learned is that when you have a stress and when you are most probably on pressure to do something because of the timing, because of the expectations, we have to be well prepared. And cases like multiple crises that we had just start telling us that uncertainty is high, especially on those geopolitical considerations. We have to always be prepared and not wait for, let's say, a circumstance that we have to act, but not clearly knowing what we are going to do exactly. So I think this was, if we want to take a good part of it, it was a lesson, I think, a hard way of learning it. But I think we all know now that our capabilities and the way how we can react on the circumstances, which are not foreseen for now. I'm stopping here. Thank you.
Thank you, Governor. Thank you for all the insights. And indeed, Kosovo and the Western Balkan region has gone through, a number of external shocks, and you have managed to weather those shocks in a successful way. Thanks to sound policy responses. So congratulations on that. So let me now move to our next panelist, Simonas. So can I ask you to share with us your views about lessons, and in particular bringing a Euro area perspective?
Yes, thank you, and a great pleasure to be in this wonderful event. So talking about Eurozone and our country, part of that, first thing, obviously this previous cycle was very specific. It was triggered by two events which were not in the models, obviously, macroeconomic models. The first, the pandemic, the largest pandemic in 100 years, and then the Russian war and triggered energy shock afterwards, also not seen last 70 years. So not only these events were not in the models, these events were not in the heads of policymakers, and not even in the lifetimes of the policymakers. Another thing that these shocks were supplied side shocks, which is typically quite hard to counteract with monetary policy measures. And as a recent blog post of the ECB colleagues shows that, which analyzed the last 50 episodes of monetary policy fluctuations in 9 countries, 2/3 of these episodes, unfortunately, ends with hard landing, and only 1/3 ends with a soft landing we hopefully are having now. So even though central banks were praised today quite a lot for making this landing quite smooth and soft, it's looking to a historic perspective, it's more an exception actually than the rule. Now, what can we learn from that, and why we happen to be landing hopefully still this last mile, but hopefully we will land in a soft scenario. So first of all, independence and credibility, that's, I think, an important factor. Central banks were building independence and credibility, which is very much related to the inflation expectations, which were pretty much anchored in this episode. And these things are not built overnight. They take decades to build. So that was very important coming to this episode. Second thing, probably we were a bit lucky. We had a financial crisis not that long ago. After that, we got a new, macroprudential policy things coming into the area. banks were strengthened quite considerably in terms of capital, leverage, liquidity buffers. So the resilience of the financial sector and the thing that we did not have financial cycle at the same time we are having this inflation cycle helped a lot and made hands much more free for the central banks to act. So that was, I think, had we had the financial cycle simultaneously, I think we would be in much more difficult situation today than we are now. And that led to the ability of the major central banks to act pretty forcefully. So ECB, raised interest rates by 450 basis points over the year. Other major banks did the same. Although we could argue that probably the actions were a bit delayed in developed economies compared to emerging economies, the final actions were pretty swift, coordinated, and forceful. And that had an effect. Now, also, another thing, I guess the coordination between monetary and fiscal policy, it was an area of research over the decades and many opinions on that. Of course, two independent policies, but some coordination seems to be valuable. And I think we saw that over the last episode, even reflecting the fact that during the pandemic years, it was a big fiscal stimulus in major economies and in developing economies, which helped to build reserves, both companies and natural persons. And these reserves were, again, very useful in the last monetary policy episode, inflation episodes, and we could weather this cycle in much more efficient way. And we see the employment rates are not getting higher. And in Eurozone, we have 6.4, almost historically low unemployment rate, which of course helps very much to get this soft landing.
Thank you, Simona. Very good points, including this final one on the coordination with fiscal policy as well. Let me now turn to Deborah. So, and I would like you to please bring also the real sector perspective. If you can talk a bit about implications of the latest monetary cycle for investment, that would be great.
Thank you very much, and I also would like to very much thank the organizer for inviting me in the panel. When we first discussed the division of rule in the panel, I was immediately saying I will not speak again as a central banker, which I'm not. I am completely on the other side. I come from one of those policy banks that are supposed to support investment and support investment to fill market gap. So actually, I'm completely on the other side of the spectrum, but still very much with some element in common in terms of the interest of what we want to happen in the economy. So if I look at the policy response from the real economy and particularly investment point of view, I think at the end we can be proud of the policy response has been, what the policy response has been achieved. We are clearly going, I think, hopefully at least that's what most of us think, into a soft landing scenario, where we actually see that inflation is going back. It's actually quite reassuring, and hopefully we will avoid a too fast correction in term of growth. The same happens also to investment. What we have seen is that through the whole period, except from the starting shock, but at the end, this post-pandemic and even through the process of a very strong tightening of monetary policies, investment has remained so far quite resilient. And I think there is something interesting happening in terms of the transmission of monetary policies, in particular in terms of the transmission of the tightening part. If we look particularly, I think Central Eastern Europe, started earlier at the European level. The tightening was very, very fast happening altogether. But what we've seen is that the full effect in terms of the transmission, in terms of investment, is probably has to come. And even if now the cycle is turning, still we expect the financing condition to remain relatively tight. And the reason is that, in fact, if you look at corporate investment in particular, what we have seen is in the last year and through the whole tightening cycle, the corporate sector has been relying much less on external finance, using much more internal resources. They actually were happy to rely on internal resources and the huge profitability that, and liquidity that they had. And now the credit conditions start tightening. In Central Eastern Europe, it has been a little bit different. I think the tightening, the credit constraint started before. But in reality, what we see is this lagged phenomenon. So actually now, if you ask to companies, they think that the credit conditions remain tight, and actually the financing conditions are tight now. And this is particularly true for SME and for innovative companies. And that's also part of the fact where we see the investment appetite to soften now. And that's a challenge because we really see that there are a lot of needs in terms of structural investment that needs to be achieved. So actually what we would need now is to find a way in which in the balance of policies we manage to support at least some part of investment, targeted investment for transformation. There are some bright spots. I think in the last years, and partly also for the energy shock, we have seen a lot of investment in energy efficiency going on in the corporate sector. It was a no-brainer with high energy costs to try to be more efficient on the energy side. And also the very high energy intensive sectors somehow have started to look into transformation, and that's also quite positive. And we have seen an uptake of digital technologies, again very positive in terms of dynamics, but there is still a lot to do. So if we have a lot of structural need, who is in charge on the policy point of view? And that's the big question. I don't think it's a primary objective of central bank. It's partly, but we are talking about the structural need of investment, and we are not talking about the cyclical rule of supporting investment. I think a central bank may have a rule, but more on the secondary point of view. If we talk about, and it's not me saying, it's Lagarde, also Alfred was mentioning before, I think there is a rule related to the net zero transition, and the rule central banks are taking, at least in making climate risk being priced in. This is essential for the whole system to start to internalize risk and properly pricing. And that, I think, is quite an important role played. I also think central banks have, of course, a very important role to play in reducing uncertainty, guaranteeing an environment, a sound economic environment that is conducive to investment. And they may have also in terms of financial innovation. I think the rule of improving the payment system through digital euro can be something quite important. But then who is really in charge? I think it should be partly on the fiscal point of view, and partly comes to institutions like mine, the European Investment Bank, even too much. Everybody is saying, you have to do all of it. I think we have a role to play as well, but we can create, in fact, the incentives that make a certain kind of investment feasible from the private sector, creating some de-risking instrument. And that's something where institutions like us can really help in the discussion of who is in charge.
Thanks, Deborah. Thanks. Very interesting insights, which complements, the central bank view very nicely. So thanks. Let me now turn back to Gianmaria and see if you can offer us additional reflections on the recent episodes and what lessons we can derive from it.
So let me try to be really, really brief, given that I had the floor already for a while. Say a couple of points thinking through what has happened. I think humility is needed. The complexity of the sequence of shocks that the world confronted is such that we need to think wisely about the tools we have for forecasting, and more generally have to think hard to interpret what went right and what did not. One issue that with the magnitude of the shocks is that some of the rules of thumb, some of the models we have are driven by the empirical evidence on which they're based. They're based on a time series of a period with more modest supply shocks. To put it bluntly, you can look at pass-through and estimate it on the basis of existing evidence, which will tell you, I don't know, that a 10% increase in electricity prices feeds, maybe 30% of it or 20% of it ends up feeding into headline prices, while the rest is absorbed by margins. That may well be a very robust finding for shocks of that order of magnitude. When electricity prices double or triple, there is just no way in which firms more reliant on electricity use can afford a pass-through of 20%. The pass-through is going to be much larger, which means that when we do forecasting, it's not just missing the shock, because that you can say, well, commodity prices did something we did not expect. But we will miss on core, because the pass-through is going to be reflected in core. So it is true, central banks did underestimate core inflation, not just the shocks, but I think a lot of the mistakes may have had to do with the magnitude of the shocks that implied responses by economic agents, which look different from the average ones for more normal-sized shocks. Another layer of complexity is something that actually Deborah was mentioning, is the impact of monetary policy tightening. So a lot of firms had taken advantage of a long period of low interest rates, particularly at the long end, to extend the maturity of their borrowing. This is particularly true in countries that issue more bonds, like the United States, but I think it's true across the board. That implies that for many years, these firms were more protected against the increase in the cost of external finance. But now, even if there is easing, you're going to see the first waves of these bonds maturing, and even though interest rates are coming down, they still remain quite a bit higher than what they used to be. So again, the complexity in interpreting the long and variable lags is there. We just have to be very nimble. I think the central banks have robust frameworks. I don't think this needs a radical rethinking of the models, but you need to be aware of two-sided risk, and you need to be aware of the fact that the size of the shocks matter, and unfortunately we may have moved to a world where shocks may be again larger than they have been prior to the COVID episode. Thank you.
Thank you, Gianmaria, for clearly describing how the complexity of shocks brings up new challenges for policy making. Yeah. So let me now move to our next panelist, Jeff. I would like to ask you to please focus on any lessons learned from the recent inflation episode. In particular, what did we learn about the risk to financial stability from sharp increases in interest rates?
Thank you. First of all, let me thank the organizers for having me on this panel on these fascinating topics, and I would like to indeed focus on the financial stability implications of the abrupt turnaround in monetary policy that followed the surge in inflation, or rather the lack of any serious financial stability problems emerging. Yes, we've seen some financial stability troubles in the spring of 23, but it was mainly concentrated in the US and it was fairly short-lived. But overall, the shift from negative rates to 4% plus interest rates has not led to any serious or widespread financial stability problems. And I think it's fair to say that this has been a surprise. Imagine you were told in 2020 that by 2023 interest rates would go from negative to 4%. I think many people would have argued that this would lead to serious financial stability troubles, because indeed there were vulnerabilities. Negative real interest rates had been leading to high house prices. There was a lot of debt, mainly in the government sector, but also in the non-financial private sector. There were clear pockets of risk. So what explains this lack of financial stability risks having materialized? I think a major explanation has been that developments in nominal incomes have been very dynamic, because when talking about inflation, we typically think about inflation as a cost of living. It's after all about consumer prices. But my expenditure is your revenue, and what we've seen after the pandemic is that nominal revenues have been going up a lot. Think about nominal incomes, wages, profits. So it was not just imported inflation, supply shocks did play a role, but also demand push inflation, domestic inflation was very dynamic. If you look at the euro area, we've seen GDP deflator inflation of 6%. And today it's still about 3%. And this higher than expected domestic inflation has helped to offset, to compensate negative surprises on the real side of incomes. So after the Russian invasion of Ukraine, you had a big downward revision in real growth, but judging by several metrics, looking at professional forecasters, looking at our own projections by the Eurosystem, what you see is that the level of nominal income, which is ultimately what matters to repay debt, has exceeded prior expectations. And so this has allowed an endogenous deleveraging of many highly indebted economic agents, households, but mainly, I think, governments benefited from this, because maturity is a key element here. The longer the debt maturity, the more this channel plays. And if you look at governments, just look at Belgium. We have an average maturity of debt above 10 years. That's, of course, excluding or not consolidating the government debt with central bank held debt. So you have a maturity of more than 10 years, which is extremely beneficial in this context. Looking at the US, where you have work by George Hall and Tom Sargent, they document a real return on holding government debt of minus 20% since the pandemic. And so you have a combination of high nominal growth and low de facto or low implicit interest rates that has allowed for automatic deleveraging. Of course, you have in the meantime new debt issuance, primary deficits pushing up debt again. But overall, I think this has been a key element to support financial stability in the post-pandemic era. There is, of course, no free lunch, and I'll conclude on that. This 2023 spring turmoil was mainly about mark-to-market losses in very interest rate-sensitive assets. So someone has to bear the cost, and also the question can be raised how you can reconcile this observation with an intention by central banks to tighten monetary policy, because this does not really sound like tightening monetary policy. And another element in this discussion is what it implies for the future. Will bondholders remain as relaxed as they have been now when there is a next crisis, when you have a combination of very high bond issuance with an intention by central banks to keep interest rates low?
The question is whether this will work again, but I'll leave it here and maybe come back in a second round to some other issues. Thank you.
Thank you, Jeff. And let me finally ask Mihailo to bring your perspectives. And in particular, I would like to ask you, to please share your views from the perspective of the small open economies. Thanks.
Yes, thank you. Thanks to colleagues at National Bank for inviting me to this panel. I think it's third or fourth time I'm here. I'll have 2.5 lessons for monetary policy from the recent episode. First lesson is about monetary policy independence, but not of the kind we discussed earlier. It's about independence of small open economy, central banks, from major central bank monetary decisions. And for a long time, we thought that small open economies could not do much about interest rate decisions of major central banks, the Fed, the ECB. What we've learned in this recent episode is that small open economy central banks do have big impact on monetary policy in their country by taking decisions at the right time. First countries to start tightening in 2001, about 6 months before the Fed and then the ECB, were Czech Republic, Iceland, Chile. And they were also the first to start easing in 2003, late 2003. So by deciding to go on their own, not waiting for major central banks, they demonstrated that they have control over inflation developments in their economies. It's not all about imported inflation or imported monetary stance. So that's the first lesson. The second lesson relates to housing markets, how monetary policy affects housing markets. When you plot house prices for OECD countries since 1995 and run a simple regression, you get something like this microphone line, 30-degree line. And then there are two little curls. There is one curl here, up and down around the great financial crisis. And then there is a second curl, half curl here, around the pandemic. And it started declining. Real house prices started declining here again. And the question is, what's the role of monetary policy in this 30-year increase in house prices? And there are various ways of looking at these questions. Hundreds of papers have been written on it. Traditional way, standard macro models argue that the impact of monetary policy on house prices is more or less immediate through expectations. What we played with at the BIS, where I worked until this spring, we let the data speak for themselves using very long lags of monetary policy. We found out that monetary policy does work, but with very long lags. 100 basis point increase in interest rates after 5 years has an impact of 5 to 6 percentage points, both in advanced economies, somewhat more in emerging market economies. Another interesting finding is that, which goes a bit against the first lesson I said, US interest rate increases spill over to house prices around the world, and cuts, of course, as well. So there is a dependence on global monetary policy stance in the housing sector. But in the end, is only monetary policy responsible for this rise in interest rates? We know that interest rates were very low for quite a while after the great financial crisis. The answer is probably not. There are some deeper secular forces behind the rise in house prices. And what exactly they are, I think we need to think collectively about these issues. Perhaps demographics, this huge wave of baby boomers, increase in welfare, desire to leave something as inheritance. Just one interesting piece of information. In Euro area, there are about 470 dwellings per 1,000 inhabitants. And this number is steadily increasing. We don't really understand why is this so. So this is the second and a half lesson. Monetary policy does have an impact. It's delayed. It's global, but it's not all of the driver of this secular increase in house prices. Thank you.
Yeah, thank you very much, Mihailo, for bringing this interesting additional perspective, including your thoughts about the impact of monetary policy tightening on housing markets. Very, very interesting. So let us now move to a slightly different topic, which is basically how does monetary policy going forward look like, right? And there are, for example, at the IMF, there are intense discussions about the potential implications for monetary policy stemming from some post-pandemic structural developments, including the larger role of supply-side factors associated, for example, to the energy transition, geopolitical tensions, the possibility of facing a steeper Phillips curve going forward, the neutral real interest rate dynamics, also the worrisome trajectory of fiscal position and in particular public debt in many regions, which could of course further complicate monetary policy making. So I would like now, to ask the panelists to focus on this forward-looking part, this focusing on monetary policy going forward, and let me ask you to please try to be concise in the interest of time. We don't have a lot of time, and I will also try to start from the left this side. So Mihailo, please.
Thank you. So let me say, looking forward, what interests me is interaction between fiscal and monetary policy. We already heard this morning there are concerns that high public debt, especially after the pandemic, will to some extent constrain monetary policy in fighting inflation. That's the traditional way to put concern about fiscal dominance. To me, what's interesting is that after a long time, maybe 50 years or even longer, in the pandemic, we have finally seen the return of fiscal policy as a macro stabilization tool. There was a brief period after the great financial crisis that fiscal and monetary policies were coordinated. They eased significantly to prevent huge distress in the financial system. But then fiscal policy tightened very quickly, and for different reasons in different parts of the world. When the pandemic struck, there was a coordinated response again, fiscal and monetary, and it surely helped overcome this huge shock for the global economy. Now, this high inflation episodes raises to me a different kind of challenge for interactions. It's the following. Finance ministries have a lot of revenue from high inflation. The reason is that tax systems are now highly elastic with respect to inflation. They're based mostly on value-added tax, which responds, which is very buoyant when inflation increases. And so now the danger, I think, is more that political forces recognize this situation and start implementing permanent expenditure programs, which have long-term negative consequences on public finances. So this temptation, seeing a lot of revenue, thinking that this will stay for a long time in the treasuries, this to me is a big risk. And that's where I think central banks have a role in their fiscal analysis to tell finance ministries, this is not permanent, this is one-off, better keep these extra revenue gains for reserve in the future. That's all.
Thanks, Mihailo. Jeff.
Yeah, so let me focus on what I believe the past years teach us about some of the key parameters that matter for monetary policy and the transmission of monetary policy. The first one is natural real rate. Very hard to measure, we all know that, but I think the overall conclusion based on what we've gone through the last few years is that maybe the natural rate has not gone up so much. After all, by raising interest rates or real interest rates into barely positive territory, we've seemed to manage the turnaround in inflation, even if there are some clearly some last mile challenges to be met. And that would be consistent with the notion that structural slow-moving factors are determining R star. If you also look at the long end of the real yield curve, you come to the conclusion that R star is probably still on the very low side. Then moving to the Phillips curve, the Phillips curve seems to be fairly steep in the recent period. The drop in inflation happened without a large cost or without almost any cost in terms of output. And that observation contrasts with the perceived or estimated flatness of the Phillips curve during the low inflation period. And so putting these two things together, I think we should come to the conclusion that you have a state-dependent Phillips curve. That's also what we seem to find when we look at Belgian micro data, where we look at pricing at the firm level and really look at the firm level how pricing is done. Then you come to the conclusion that you have a state-dependent and fairly steep Phillips curve in marginal costs. I still struggle to think what this exactly implies for monetary policy or whether it's a good thing in all respects, but I think in general having more price flexibility seems welcome, as it should lower the costs of inflation. Of course, it can also point at firms having become more attentive to inflation. Related to that, and that's the final element, if you look at not just the slope in the Phillips curve, but also the intercept, which is what inflation should converge to after all shocks and cyclical factors have gone, I think there the news is fairly encouraging. Looking at inflation expectations across all sources, and we've, in the last few years, have gained a lot of ground in terms of covering inflation expectations, not just of financial markets and professionals, but also of households. I think it's fair to say, or you can say that they are in general quite aligned with the inflation target. And yes, we've seen upward movements of inflation expectations, especially at the shorter end and for the household sector, but they have come down and don't seem to point at a regime shift towards higher inflation. And I think that's quite an achievement because given all the shocks that we've observed, that's really an achievement. And so we come to the conclusion that we've gone through something like a credible disinflation with fairly anchored inflation expectations, which also do seem to matter for actual inflation developments. And that's obviously a big asset for central banks, but also for governments who, I think, rather want to avoid wanting to pay an inflation risk premium when they issue debt. And that's it.
Thank you, Jeff. Let me now pass the floor to Gianmaria. Any further reflections on this, Gianmaria?
So I would say you were referring to rethinking frameworks. I think the risk of a higher likelihood of larger supply shocks is something that encourages the use of at least alternative scenarios, so it becomes more difficult to think of what a baseline is for policy decisions. You could have sharply different outcomes depending on the realization of some variables, and this is, I think, something important to internalize. This was pretty obvious during the pandemic, of course, but I think it's a lesson that is important to keep in mind. I think, of course, we need to do ex-post analysis of what we missed, but in doing that, it is very important to remember that the range of outcomes when the policy decisions was taken, the range of possible outcomes was very large. So we may say that ex-post, you had a lot too much stimulus in country X. Ex-ante, you had a serious possibility that you could have more substantial closures, more substantial new waves of the pandemic, more risk of persistent weakness in economic activity, people become detached from their jobs. That did not materialize. There was a cost to it, of course. You put a lot of money on the table. But I think one has to be a little bit careful in just taking a counterfactual whereby in a purely linear way in which you could have done, a couple of percentage points less in stimulus and still, and get just a little bit less demand pressure. One last thing is when you have these large shocks, we need to look back at the relevance of what is now more elegantly called unconventional fiscal policy, fiscal responses that alter the price of key inputs in production like electricity, that clearly mattered in explaining cross-country differentials in the size of the shock. We normally hate energy subsidies as public institutions think, it's a big waste of money, you don't change behavior, but clearly there are circumstances where other factors come into play, and hence, again, this is something that the role of these interventions, sparing, hopefully, is, again, something that ought to be on the table. Thank you.
Thanks, Maria. Very clear 3 points. And thanks for bringing the point out, the particular difficulties of making monetary policy decisions in the context of extremely high uncertainty. So that's a very good one. Deborah?
Yeah, I think just having 1 minute, I will focus on one concept, and it's actually the importance looking forward of finding efficiency waves to catalyze private investment towards certain means. And one thing that I would like to mention is at the EIB, we just did a study actually specifically on the Balkans, and we look at all the loans that we give to banks for banks specifically to lend to SME, and sometimes they are targeted on innovative SME or targeted even a gender component, but mostly is to SME. In the study that we did, we look at the firms that actually received this intermediated lending that results as a cheaper lending for the final beneficiary. And we compare that to firms that ex ante were identical but didn't receive the financing. And what we see is that 3 years after actually in the Balkans, the firms that receive our intermediated loans, they grew more, they invested more, they were also more innovative. And the effect is much higher than in a comparative study that was on the EU side. All of this to say that there are mechanism that can really work, and I think we have to do more to make this mechanism work and be more diffuse. So efficient ways for catalyzing private resources toward the investment needs that we have.
Thank you, Deborah. And indeed, increased financing for SMEs is really an important issue across the Western Balkan region. Fully agree. Yes, Simonas, your turn.
Yeah, looking to the future. So first thing, I think we should not broke what is not broken. So we should embrace what helped to have this cycle to be ended in a soft scenario. So policy space, very important, independence and credibility of central banks, very important, financial stability and strong fiscal financial sector is crucially important, against any shocks in the future. Second thing, central banks should be very open-minded. It's pretty sure that we will have a lot of uncertainty looking to the future. We have all these global mega trends going on with debts at historical levels. We have aging population. We have technological changes which will change labor market productivity, and that's very much linked with the central bank's mandate. So we should be very open-minded and of course to build our models on scenario analysis and not on point estimates. And last thing, we should be prepared for unexpected things to happen. So we should be very, very flexible. We had supply shocks during pandemic. In geopolitical tension context, we could have, even larger supply shocks related to critical components of production. So we should not rule out that and try to prepare for a very turbulent future, I suppose.
Thanks, Simona. And finally, Governor, so as a unilaterally raised economy, you are not facing some of the standard issues related to monetary policy, and in your previous intervention, you lay out some of the the actions that you are planning to take on going forward. Any final thoughts that you would like to share?
Yes. Again, thank you very much. Actually, as I was saying, the structural challenges to the economies could not be considered to be addressed only by the central bank. As I mentioned, those are very much connected with alignment with fiscal policy. And I think in this regard, we have shown a good case. As I said before, we don't have this aging issue. And the second, our public debt is really low. So it was 20% during pandemic. Debt to GDP now is 17. So due to strong fiscal position and let's say quite well tax policies, we don't have this pressure. However, labor market issue remains one of issue that is one of the risks that we foresee. Of course, energy is one of the issues which, again, we are volatile to this. But in principle, as the central bank, very limited tools on traditional monetary policy tools, we will be carefully monitoring the situation. And of course, as we have by law the obligation, we will advise what is necessary with the government when it takes the measures that they take for the fiscal point of view. So in overall, I think this alignment is needed, and this kind of conferences when we share views and take lessons from other countries, I think it's really important to keep continuing and exchanging. In the past, we have been reading by the books or, I don't know, the different publication what happened. Nowadays, due to this very good communication and interactivity, I think there is no need to wait for papers unless we have this direct communication and understand what is happening and how is the best approach to deal with this. So thank you very much.
Thank you very much, Governor. And with this, we are running out of time, so I will not try to summarize the discussions, but I really think that panelists have brought different insight from different angles and perspectives, which has enriched the discussion, and in a nutshell, I think lots of food for thought. So with this, just let me close this panel by thank you all the panelists, and thank you again, Madam Governor, for the invitation. It's really a pleasure to be here.
Ladies and gentlemen, dear guests, we now invite Ms. Anna Mitreska, Vice Governor of the National Bank of the Republic of North Macedonia, to wrap up the conference. Ms. Mitreska, the floor is yours.
Good. So I have the honor and the privilege to wrap up today's event that I trust was insightful and also navigating for all of us in these challenging times. But at the very beginning, let me take a moment and acknowledge our incredible lineup of speakers and panelists who really generously share their time and their experience to be here with us and to contribute to this event. Well, commonly the ending of the conference should be very short, but also pin down some of the important takeaways, and I think that you will agree that one of the most important takeaways from this event rests in the notion that central bank autonomy is arguably the most optimal governance structure. This is strongly supported, particularly by the experience of emerging markets in recent decades. Independent central banks that are able to conduct monetary policy largely free from political interference, as we have heard, have historically demonstrated a strong ability to deliver their mandates. And the most recent inflationary episode assured us again that investments in independence, but also transparency and accountability of the central banks is indispensable for efficiently addressing risks and also accomplishing our goals in an extreme uncertainty. And this in particular nowadays when central banks are granted expanded mandates. As one of our keynote speakers, Mr. Kammer, noted it in his address, central bank independence should always remain the foundation of the policy framework. It is a vital public good that must be preserved and also strengthened. So in this way, the second key message, I think, is that despite all the turbulences, perpetual shocks and crises, central banking community excelled in combating inflation, but also at the same time strengthening, not only preserving, but also strengthening the stability of the financial system and enabling soft landing. And indeed, I think this is a success, as a very recent research done by the ECB looks back at the total of 48 monetary policy cycles in 9 economies over a period of 50 years, and concludes, as we have heard at the last panel, that hard landing episodes are usually related to supply shocks, prompting for steep rise in interest rates and faster loosening of the stance. And this usually impacted the financial stability as well. Soft landing episodes were usually related to demand shocks and much smoother interest rate cycles. This time it looks that history does not repeat, and as the Bank Board member from the Bank of Lithuania mentioned, it seems that this episode is more of an exception in historical terms. So I think that strong and independent central banks were able this time to navigate through the storm with a very clear focus, and also the major financial regulatory overhaul that was done in the past years and continuous efforts of the supervisors and regulators to be as prudent as needed, this also elevated the resilience of the financial system to shocks. And therefore, in the midstream of multiple of shocks, we are reaping the benefits of long-standing investments in the capacity, in the resilience of the central banks. Nevertheless, as we have heard, the confluence of unprecedented risks, the risks for inertia in the core inflation, the fiscal monetary policy nexus, but also the changing global landscape, including looming geopolitical issues, climate risks, digital transformation, that were very diligently discussed during the conference. I think the third message is that all policymakers must stay alerted and vigilant and prepared to change and act, as was discussed within the last panel. And last but not the least, motivated by the fundamental principle of inclusiveness, our panel on gender-inclusive finance, I think, provided an excellent stock-taking on the issue, illustrating the main obstacles for stronger financial inclusion of women, as well as the main benefits for the overall economy and for policymakers from lifting barriers and also ensuring lower gender gap in finance. So I'm confident that you have enjoyed all the discussions and insights along the lectures and our 4 panels. At the very end, on behalf of the Central Bank, first allow me to recognize the hard work of the organizing team. Their dedication and their tireless efforts behind the scene really ensured smooth running of this event. But thank you to you all for your presence, and thanks to all the involved stakeholders who made this event run smoothly and also successfully. Thank you.